Hello and welcome everyone to the Capitalmind podcast. If you'd like to know more about us, visit capitalmind.in, and if you'd like to invest with us, do visit capitalmindwealth.com.
This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. Clients of Capitalmind may maintain positions in the securities discussed in this podcast.
Welcome to episode 39 of the Capitalmind podcast. We're here, this is Vashistha and me, Deepak Shenoy, at Capitalmind, speaking about an interesting thing that we've wanted to talk about a lot, largely because we get so many questions about it. What is a portfolio management service, also known as a PMS? To people not in the financial field, this may sound strange, but the word PMS here actually does not mean anything to the contrary or to something that's bad, but it's actually a manager who manages your money for you. And we've brought together an entire episode that will talk about the various aspects of a portfolio management service. And as a disclosure, of course, Capitalmind is registered as a portfolio manager and runs a Capitalmind Wealth PMS. We're about 450 plus crores in assets that we manage, and our learnings will come through in this entire podcast. Welcome, Vashistha.
Hey Deepak, we did a podcast last time in 2019. It was about cash flows and managing them and so on. उसमें एक quote था that was very popular on Twitter because our guys kept tweeting it out again and again, where you said that at the age of 30 you were bankrupt. So from being bankrupt to managing 450 plus crores in AUM and 1,000 plus crores in AUA, it's been quite the journey. And
It has.
And we were joking the other day in office the whole game nowadays seems to be intraday option selling and training around options. And I remember in 2016 when I just joined Capital and moved to Bangalore, we had two months of payroll left in the bank, and we also did options workshop, but that was more conservative and it was not as fancy back then, but we were just joking the other day that maybe if we had just continued doing this, we would be more profitable than running a PMS.
Well, I think it's always true. But the only problem with that is that has a shelf life, and hopefully this one doesn't. So, but I mean, you're right. In the end, what makes money sometimes is the giving of knowledge. Sometimes has more money in it than the doing of whatever it has.
But in a sense, by building this PMS over the last 4 years, what we have done is basically graduated from giving gyan on how to do things to actually doing and managing money. And we've learned so many different things, and it's completely different ball game. And that's what we're going to discuss in this episode. How is it? Why did we start a PMS? And why do we run it the way we do it? It's done slightly differently, and so on. So let's go back to the genesis of this, right? We used to run premium. You started it out as a blog, and then you added premium. Your hypothesis was people will pay to read what you write. And just walk us through, how did that move from the DIY model to managing people's money?
Yeah, this is, when we started off, I think my first year was if I can get 100 people to pay for what I write, then there is a model here. This is 2013 when if you told people that people would pay for content, they'd be like, well, are you out of your mind? And, and I got that. We talked to a few VCs. They said, listen, this is not a fundable model. And not that I needed funding at that time, but I was more like, I'm going to try this out. But from there, I discovered over the years, and the first few years were very complicated because the issue really was we started off saying, okay, let's do research. And you can't do pure research because people are saying, listen, what do I do with this research? No, well, you can buy stocks because there's real value in looking at data and analyzing stuff. And some of that analysis can be purely quantitative. Some of it can be partly qualitative plus quantitative. Then we can buy stocks. We build a portfolio of them. We started calling it, and the initial set of portfolios were primarily around momentum, and we'll come to that. So, but primarily around the technical concept of stocks breaking out, showing great moves, and were also reasonably interesting fundamentally. We started building out portfolios. We started building that portfolio of saying, listen, it's a great opportunities for the short term, and then we've got great opportunities for the long term. So there's a long term portfolio and a short term portfolio. In fact, that was what it started off with. It morphed further. It said
It was called the momentum portfolio.
it started off, yeah, it was called momentum almost.
That was you looking at charts.
That was me looking at charts. And I didn't, at the time, we started off building, so one of the things that I wanted to build at that time was the ability for anyone to be able to look at data and automatically select their own stock. So we built Snap, the beginning part of it, within the concept called the outliers. Now, the outliers are very interesting because the idea was I could tell you which stock is making a new high. I could tell you which stock is, which set of stocks are making, say, a moving average crossover or whatever it is. So, there are a bunch of technical criteria where you can see uptrends and downtrends. But what if I ranked all the stocks based on the strength of how strong or how many such indicators worked in that favor? You would get the strongest stocks with the highest rating and the weakest stocks with the lowest. So the outlier concept was that anything that was out of the ordinary is of your interest. You don't care if a stock goes up 1%, you care if a stock goes up 10. But there's so many stocks that you can't keep mapping and looking at all of them. So if we brought together a tool that said we look at the universe and highlight the most outlier in terms of price or volume momentum to you. The idea here was that people would look at these things and discover their own stocks. So we just put it out. We've soon discovered that this is great, but people actually wanted help in saying, listen, I'm looking at this. I want validation. I want you to tell me that this is okay to buy, because there were a lot of weird, strange stocks. Because you look at something quantitatively, you'll get some, 2 rupees stock becoming 2 rupees 50 paisa also. But those are not stocks you want to buy. And I thought that was obvious, but people said, no, it's not obvious. And you need to kind of filter this down for us. So we said, okay, let's build in filters. We said large cap filters, mid cap. We added a lot of layers onto the outliers. But part of the process of doing so was also, listen, let me show you how it works. Let's build a portfolio from these outliers. That became momentum. I would actually manually look at each stock, which was an outlier, and say, okay, this qualifies. Let us go and buy this. Sometimes the outliers were strange because you didn't know why they were moving. They were very boring stocks sometimes. They didn't have any fundamentals. They were moving. And suddenly you find that after some time, after they moved, they would start showing some signs of news. Oh, this guy's this new product has been launched, or some acquisition has been done, and so on. The idea was that how does the market know this already? And answers obviously are that somebody knew, and perhaps they started buying a little bit early. But however it was, the idea was focus on telling people what to do, so they could do it themselves. I believe firmly that people will look at stocks independently from their mutual funds. After a while, we discovered that one more part of the world, which is the fixed income world, is dominated by mutual funds because you can't do it yourself. Plus, it's not tax efficient. So we built a fixed income portfolio. So now we had a momentum portfolio, a long-term portfolio, a fixed income portfolio, and we're thinking of this a little more, through this process. It suddenly became, Deepak, why are you looking at charts every time? A long term, I understand, I remember you asked me, why are we looking at charts every time and adding some 10 stocks and removing something and all that stuff? Can't we, because we've got my background is also in algorithmic trading. So I've used data, I've used algorithms, I've written them to analyze stocks and then come back with specific things. And all of us were in that same kind of tune. We're a motley crew of people who aren't from the financial world. Literally nobody is. I think Shrey is probably the only guy who can qualify to say he's from some financial world, but otherwise all of us are not from finance as a background. So
he certainly has the fanciest degree of us all.
I mean the Harvard and Yale and all that. I mean, it's like almost like it's a paradise of degrees. But in that context, because we came in new, we didn't have to rely on things like, do I know the promoter? Do I know the founder? Do I know anything about the company that other people don't know? We were like, no. We want to know what everybody knows. And because we are so sure that people are ignoring the obvious, that we could just write quantitative tools to look at and analyze the market.
And this is back in 2016 or so, right? This was before momentum became popular as it is today.
Yeah, in fact, I remember writing about momentum as a concept. Now, I didn't call it that, But in 2007, 2008, so 2007 was when I wrote my first set of algorithms as a part of an earlier startup called Money Yoga, where we were trying to discover stocks making new all-time highs. There was an interesting startup in the US at the time called StockTwits, and they had a video a week. This is before videos became popular.
They're
video
now in
a
India,
week.
by the way.
Oh, StockTwits is now in India. Yes, yes, it's very interesting because what they did at the time, and they were sold to CBS in a few months after they were born, is that they would identify a stock making an all-time high and prepare a small fundamental and technical thesis on the stock, which was almost funny also because many of these stocks were funny. You just start writing about them and you know that something's happened. But what excited me about the fact was that they were only looking at all-time highs. In 2007, if you told people you're buying stocks at all-time highs in India, they would say you're in doofus. You should buy stocks at all-time lows, not at all-time highs. I mean, how dare you, kind of a thing, okay? Because it was so new. So when I'd met a lot of people, they were all so there was this tribe in Bombay. I'd moved to Bombay at the time, and there was this trading tribe created by the concept of a trading tribe was created by Ed Seykota, who's more famous for being interviewed in the Market Wizards by Jack Schwager, and has generated, I think, a phenomenal return over years. A purely quantitative person in terms of programming, and who looked at trends in commodities and made a lot of money there. So we were trying to apply this in stocks, and there was this trading tribe in India, probably the only one in India at the time. And I joined them. And again, here is one place people were not embarrassed to buy at all-time highs. Some of the people from that group are now quite famous in terms of the trading philosophies, but and trading itself. But what was interesting was this was one place where you didn't have a problem. And if you talk to traders, their time frame was hours and maybe 1 or 2 days. And 2007, as wild as the market is today, I think 1.5x that was what it was then, because that time you could see stocks walk into the market, walk out with a 5% gain in like 15 minutes, and you're done. So that's a day is done for you. 5% gain at that time was significant. Even now it is. It's like more than a year's return in a liquid fund. But if you look at something like that, momentum was what traders did, and value and buying at lows what investors did. But I was really sure, even through that time, that it didn't matter if you were a trader or an investor, that all-time highs were always an indication of a good trading strategy. And sometimes, because you won't be right all the time, sometimes you would discover a few stocks that would give you 10x, 15x, 20x. We discovered a few of them at that time, from 2007, 2008, and while building this process. But when we started off with Capitalmind, the underlying philosophy also was that this is a difference. If you look at things quantitatively, you will actually make a lot of money by simply looking at moves and trends in the market. The first few years were manually identifying those trends. When you came in, I think the first thing that we did in 2016, it was roughly around the demonetization time.
Yeah.
In fact, just 5 days after demonetization, I remember we wrote a post saying we are selling everything. And 5 days after that, we said we are starting something called a 30 strong stock portfolio. The idea was 30 stocks in momentum that we identify. The misgivings of selecting stocks manually make you desire to keep some of those stocks when the market goes down. And in 2016, during demonetization, the market had gone down. So the idea was now sell everything, start everything clean.
In fact, that portfolio, when we released that post, it was the low of the.
It was literally the low of the, and it was quite remarkable that we were lucky enough to have gotten at that time. And remember in Twitter they said, "Deepak, you've sold everything. You're not loyal to the country, whatever," and all that stuff. And we were like, "No, we've sold everything, but we bought everything right back." And that does not prove we are loyal. We're just saying, in this downturn, if some stocks still show strength, then they're worth buying. Because if you're buying at the low point of the market and you're buying stocks at all-time highs or near all-time highs, you're buying really strong stocks in a weak market, which tend to do well. In 6 months, the stock portfolio had done an absolute return of 24%. Now, much more than the market. The market return was 10 to 12%. So we were like, okay, there is something here. We ran we said, okay, we're going to run this as an experiment for 6 months just to see. And we said, we did it. A couple of months later, we did another round, and this time we called it, listen, this is a permanent-ish momentum portfolio.
That's when we said we'll have a frequently rebalance portfolio. I mean, on a schedule. So we'll set every first Monday of every month is when we will rebalance this portfolio.
And you know what actually started to happen was that because the returns were interesting, um, people got interested. Now 2017 was another time of great madness.
And just to bring us back to the topic, otherwise we'll keep going on momentum.
Yes,
Is this is the same time when we had applied to become a PMS?
I think by 2016 we had started to realize something, even while all this momentum and thought process were going on, is that our customers were telling us this, Deepak, this is all good. You guys have a great, interesting philosophy and all that stuff. You're telling me to do this. Can't you do it for me? And we said, we analyze. And I have written a post in 2011 or 12, which talked about creating a hedge fund in India where you could manage other people's money. Now, of all the things that we could do, the only legal thing that we could do is become a portfolio management service by SEBI. We needed a 2 crore net worth. We needed a few things that was part of the process. But uh, we had everything except the fact that we didn't know that that was what we needed to do. I think we didn't have the 2 crore net worth at the time, but that was one way we said, okay, we could manage people's money. So we asked around and we said, if we did manage your money, would you give it to us? And the limit at that time was 25 lakh rupees. You had to have a minimum of 25 to invest in a portfolio management service. And we said, okay, let's do this. Let's go apply to SEBI to become we will do it for you service rather than we asking you what to do or we're telling you what to do kind of service. So
this is let's break down PMSs for a bit. PMSs are three types, three things you can do: discretionary, non-discretionary, and advisory. Right. So what is this? This is discretionary.
Yes. So let me tell you from another point of view. Let's say you wanted to manage somebody else's money. You could go to a friend and say, give me your account username and password. But if you, because of SEBI's rules, if you do this, you're actually illegally managing his money in the sense of you're saying you're doing something for a friend. As long as he doesn't complain to SEBI, you're okay. If he complains, it's possible that they could take some action against you because you're running what is called an illegal portfolio management service. Your broker could do this for you. Your broker does this for you. So he'll probably call you up and ask you, I want you to buy this stock. Will you buy it? You say, yes. And he'll say, sir, can I punch the order for you? And you'll say, yes. And then he'll punch the order. So in a way, he's getting a confirmation before every trade from you. This is also technically a managed service, but brokers do it often and SEBI doesn't take any action on these kind of things. But SEBI has. Recent past, they have said, listen, people have complained that you have punched in an order without telling them. Do you have a recording of the call you've made? So now brokers have a recording of the call that they've made, so the compliance has increased. But what actually has happened on the other side is also that SEBI has said, listen, we have a mechanism where you can say, I will buy or sell stocks for a customer. He will give me permission to do so, or he or she will give me permission to do so, but I do not have to take confirmation. This is called a discretionary PMS, where it's the manager's discretion to say how much he wants to buy,
when he wants to buy, how much to buy.
Exactly. So there's a complete discretion of the manager. This discretion can also be said as, I will buy it, but I will get your confirmation first. Okay. So I will suggest what to buy. You will say, okay, and then only will I buy it. Now, some people may have these rules that say, well, no, you got to tell us what you're going to buy because you're going to buy for us using our money. So please tell us what it is and then only buy. So the non-discretionary PMSs are people who are PMSs which so the same PMS company can have a discretionary strategy and a non-discretionary strategy. Obviously, the issue becomes at some people will also say, listen, why are you buying on my behalf? If you're telling me what to buy, I can buy it myself. This becomes an advisory, where you only tell them what they're supposed to do, but they actually go ahead and execute it on their own. Now, typically family offices who may have their own execution teams might say, I'll take 4 or 5 advisories and I will select out of them which the best stocks are and execute them.
Or you might use like, I want, advice on how to structure my debt portfolio.
Correct.
So you can go to a portfolio manager and get advice on that. Or you just wanted, mutual funds.
Yes.
Not even direct stock, or maybe direct stock. Like you could come and say, I have all these 20 stocks. Can you advise which ones to keep, which ones to cull, and so on?
This is so now RIA concept has come. That time it didn't exist,
Yeah.
but the RIA concept is now allowing you to do something like this. But the PMS is primarily for people who have more than the minimum, which was at that time 25. So we said we'll do a discretionary PMS because essentially that would give us the flexibility to be able to buy and sell whenever we wanted. Because imagine you scale and then you have 500,000 customers, then you have to call each one and ask them whether we should buy and sell, and some of them say no, we'll get back to you. At which point you can't use technology, right? Because now you're suddenly saying, oh, this guy hasn't given permission, so don't buy for him, but another person has, so buy for her. And by the end of this game, you're going to be like, you can't run a scalable strategy. So we started off saying, let's build a discretionary strategy, let's try and do a few other things. And we talked about
So
the
you mentioned
workings.
technology here, and we did something different, and we chose to do a goal-based approach for our clients, right? And which has evolved since then as the minimum went up to 50 lakhs. We have moved slowly from being entirely about goals based to being rules based in terms of the strategies that we have. So let's discuss that for a bit.
Yeah, that's so. When we started off, we said, okay, you could be another PMS, but can we just run on the Capitalmind brand and say, oh, please invest money in us? The other problem that we realized was that the people who were giving money to PMSs were largely going on this extreme risk bandwagon, which is, I'll give you 25 lakhs, just go and go crazy about it, and just invest it wherever you want, and you will make lots of money and all that stuff. And then the managers were expected to take a lot of risk, and the managers would take a lot of risk, and sometimes that risk wouldn't work. And 2016 we could see that. But we said, okay, there is this problem. Now, if you give 25 lakhs to a person to take a lot of risk, that means you're already worth 1 crore or 2 crores, because that's the person that can say, take a lot of risk with the 25 lakhs. This automatically meant that people whose net worth was 30, 40, 50 lakhs were completely left out of the picture. They were like, I'm not giving you 25 lakhs to take this kind of risk. I mean, we're not going to do it. So, how do you now balance that out with the fact that a lot of our customers were in that range? They were telling us that, listen, we're not going to risk all of this. So, can we figure out a way that we can do something in a less complicated manner, taking relatively stable amounts of risk? The second part of this was that we had already identified that people need help with their own personal financial planning, in the sense that while you may have a lot of money, you may not be financially stable, in the sense that your money is lying around in fixed deposits, which is inefficient. It's lying around. There is money that is there, but it needs to get invested, because otherwise you're not going to make your goals at the time. You have children, you have to educate them. You know that their education costs are going to be high. You have to plan to get to that point. And many of them were like, okay, 50 lakhs is there, it's okay. But when we pointed out that, listen, 50 lakhs is nowhere near enough, and you're going to have to build a corpus of nearly 3 or 4 crores the next maybe 10 years in order for you to be able to A, retire, B, plan your children's education, C, do all the other things that you think you can do, but you can't. We built a concept around a tool, a thought process called goals. So the idea was, you compartmentalize your life into each different goal. Each different goal is one, for instance, is retirement, and that retirement concept is work because you want to, not because you have to. That means you're working simply because you love to work, and the money that you have stored somewhere can actually generate enough money to meet your expenses for the rest of your life. This is effectively the feeling of retirement, which is what we wanted to start off and said, listen, every person has a number, and that number is something, and we can tell you how that number is reached at. Because if you're spending 1 lakh rupees a month today, in 15 years you're going to be spending 2 lakh rupees a month, just at 5% inflation. And if I calculate these 15-year slots till the time you die, which is at the age of 90 or something like that, and I looked at it and said, listen, for every year that you're increasing your spending, I am going to need a corpus big enough that generates enough returns so that it can both meet your needs, and sometimes you may have to eat from the corpus. And but then what's that corpus required, so that at the age of 90 this corpus dwindles down to zero, assuming your expenses remain the same and increase with inflation every year? In the sense that, if you're spending 1 lakh a month today, it's the same 1 lakh which is adjusted for inflation going forward. We talked to a lot of people, and then we helped build models around this. So we said, okay, this is what you're going to need for retirement, this is what you're going to need for your children's education, because that's usually a number. That number can be something like, if you're going to the US, for instance, your child, um, you'll have to spend 35 lakhs per year, because about $50,000 roughly per year into 4 years. Uh, and then that amount is today. We have to adjust that for inflation and rupee depreciation and all of that stuff. So how do you find out what that number means when your child goes to school, which is about maybe 9 years, because the child is 9 years old today, or 15 years if the child is 3 years old today?
So this sounds like, and these are calculators that have been around for a while. We also built one, a visual one, which made it easy for when we had these conversations with clients, where it made us easy to explain their own financial situation to them.
Which in fact, I think the first set of things was a Google sheet.
Yeah.
And then you took this, and then I remember when you came in, you were mostly involved in options trading, and your background was in design. But you took over the front end of the building of this technology, and then you built what became, or has, it still is, Plan, which is a planning tool that could automatically determine exactly how your life should go. So it's not only that you need to reach 3 crores, but also how much money do you need to invest in order to get there, how your trajectory or this glide path from now to then should be, because it's an accelerating curve. So it's a parabola in an upward direction, if you may. But also because you expect that people will not just save an SIP of say 1 lakh rupees a month. They might say, listen, 1 lakh rupees a month today is not the same as 1 lakh rupees a month 10 years down the line. So it's obviously going to increase. I mean, it's going to be a larger amount, because if I'm making X and I'm spending Y, and X inflates by income goes up by inflation, my expenses go up by inflation, my savings will also go up by inflation. So technically, I could have an increasing SIP. So all these calculations were built into that tool, I remember, and you still have it all in plan.capitalmindwealth.com.
Yeah, you can go and play around. But that's not where we stopped at. We still use that, but that actually just flows into our backend as well. And we use that for deployment and managing how balancing your goals and asset allocation and so on.
So yeah, no, this is the brilliant part of, I think, where it started off, and even now that continues.
Which also meant that we couldn't have used anything off the shelf.
Yes.
Most PMSs in India use a software called Wealth Spectrum, right? And we had certain limitations because we wanted to do all these new things, and that would have been a problem to do it in a third-party software.
Yes, and we were one of the few people that were actually using debt, because we were saying, don't take so much risk. So when people gave us 25 lakhs, they were saying, no, not all of it in equity. Well, that's fine. Let's do 60% in equity, 40% in debt. Why are we doing this? The 60% in equity would give you the equity level returns, the 40% in debt. And that time, debt was giving fairly reasonable returns. So what we would do then, that 40% would go into direct mutual funds. That's again a speciality of ours, because every other PMS that was doing this was not really using direct. They were using regular mutual funds.
But they can't anymore.
No, they can't anymore. And SEBI changed the rule in 2020. So when we started off, we started using that. But the other interesting thing was, it was dynamic. It wasn't like I was going to do 60% debt, equity, 40% debt each time. The idea was that if the 60% equity started to go up so much that it became 70% equity, your subsequent SIPs would get deployed towards the debt portion automatically. And the system would determine every month whether we should deploy money more into equity or more into debt. We try to optimize for taxes as well. So it was a complex system built through technology that we built, and we wrote internally itself, because no other tool was doing this. Even we saw at that time, there was a bunch of US software companies like Wealthfront and Betterment and so on. They didn't have the deployment sophistication that we did, which means our entire deployment was automated to the extent that we would know exactly how much would go into equity. As a fund manager, I would design the portfolio, the equity and debt portfolios, which mutual funds to invest in debt, which equity stocks to buy, as a model level. But each person, because they had a different amount of cash, each person would say, well, you need to buy 2 stocks of this and 5 stocks of this for person A, and 6 stocks of X and 10 stocks of Y for person B. The technology built it together, and throughout what we call a trade sheet. So the idea is the trader doesn't have to now say, okay, for this order person I have to buy 2, for that person I have to buy 7. That's not his concern. The trader just simply says I have to buy 7 stocks. The system will allocate it automatically. And this is where I think the investment in the technology right up front kept us on our toes, because we had this goal-based system. The goal-based system would flow in, and the system would do all its little magic inside and say, well, okay, this is the trade sheet you need to buy for equity. This is the trade sheet you need to buy for debt. Please go ahead and execute.
And then we would allocate to all clients and so on.
Automatically.
Yep.
And the brilliance, the problem really was sometimes if the trade sheet said buy 100 shares of some company for person A, we couldn't sometimes buy the 100. We could buy only 90 because of liquidity or something like that. And the system would automatically adjust and say, okay, well, if you bought 90, that's fine. Just go ahead. So we could literally do a daily purchase of stock. So if I had to buy 100, I could buy 10 on the first day, 20 on the second day, 30 on the fourth day. And it would automatically allocate appropriately to each customer.
And in fact, I remember the early set of customers, they in fact demanded, some of them, they demanded that, look, I'll give you 50 lakhs or 25 lakhs, whatever. Don't go and buy everything on day one.
Yes.
Because please give it some time, buy it over a period of time. And that was a default behavior anyway.
No, and it's very interesting because we started off in 2017 November. In 2018 January is when the chief finance minister of the day introduced the budget in which capital gains was taxed for the first time in 14 years, long-term capital gains. So the market started to fall. So a lot of people benefited because they were able to spread their investments over 6 months rather than all at once. But more importantly, we wanted to give comfort, because anybody who's giving 25 lakhs at one shot doesn't want to see that go down or go up or down too much.
And it's behavioral, right? It's like you can do an analysis backtest and it will tell you that, most of the time if you just deploy together, you're better off eventually. But, the first year, if you have a huge drawdown, you're going to get jittery. You're going to get scared.
In fact, even now I tell people the same thing. If you ask me now, I have a lump sum of 50 lakhs. What do I do? Put it in a liquid fund, feed it into an equity fund over a period of 6 months. You will feel so much better. It's simply behavioral. You may feel a little pang of regret saying, listen, if I had invested all of it at one time, it would have gone up. But I think that pang of regret is much more preferable to the regret you will feel if you had put all of the money at once and it had fallen 30%. So you optimize for regret. So whichever regret is less is better off for you. Because in the end, what matters is that you sleep well. We recognize that in the PMS. One of the reasons why you want to sleep well is also saying that, listen, I need 3 crores for my retirement. I don't want to worry about am I getting there. Because we would show you on plan, and there was another tool called Progress, which you built again in, I think in Jan of 2018, which was actually, it would show you the portfolio, and we'll talk about that as it is. One thing it did show you is if you had these goals, it could actually show you exactly where you're supposed to be every single month from now till the point your goal is achieved. So at any month, you could actually say, listen, you're supposed to be at 26 lakhs, but you're actually at 27. So you're doing well. Don't worry about it. If it wasn't, it could be because of a variety of factors. The market was bad, and therefore you're not as much as you should be. Or it could simply be that you haven't put an SIP in. Many times people forget to put an SIP. You're supposed to invest a certain amount of money every month. And that was also something that differentiated us, because most of the other PMSs said, give us 25 lakhs, then give us another 25 lakhs. Otherwise, don't talk to us. We were saying, no, after your first 25, give us anything.
5,000, 10,000, 20,000, whatever.
Because we can deploy it. And SEBI cares about the first 25. SEBI doesn't say that you have to get increments of 25. SEBI actually wants us to help people reach their long-term goals.
In fact, portfolio manager, the way SEBI has described it, it seems it is supposed to be, personalized for each person.
Yes, it is. It's supposed to be a hand-holding, because otherwise...
And PMSs are supposed to be fiduciaries, right? You have to take care, and you're responsible for the decisions you make for the client.
In fact, what is important here is that you are actually investing on behalf of the customer. It is not a pooled investment. It's not like a mutual fund where you take the money and you say, well, you know what? I'll tell you how the overall pool is done. That is not the trick. When a PMS buys a stock, you're the owner of that stock. You're the one who has the voting rights. You're the one who can go and complain that the management is paying itself too much. The PMS manager is only a manager. He's not the owner of the stock, and therefore somebody has to take a little more care and little more personalization when they do it. Now, typically they don't do it. They simply say, listen, trust us, we manage money. I'll manage your money just like I manage everybody else's, and we're fine. We're saying we're going a little bit further and saying we're going to help you reach your long-term goals, whatever makes sense for you, rather than for everybody else.
So we've reached this point now where we are managing 450 plus crores in assets and about 1,000 crores and under advice. And we've explained what both of them mean. And we've gotten here without using any distributors. And you were mentioning like other PMSs, they don't really care about, uh,
personalization
yep.
or anything like that, because they don't talk to the customer directly. They
Correct.
get somebody else to bring them in. And Vashit, one of the things I think when we discussed this, we were very gung-ho on this, saying, listen, we have a captive customer base, so we don't have to go use distributors because we know our customers.
And also it was difficult. Like we were building tech from scratch and like, okay, then we have to build a distributor module as well, because there the distributors own the relationship with the client and not the PMS per se. And, we have to give them views about these are the clients you have brought, this is the fees that we have charged, this is your cut and so on.
And what increasingly was happening was the sophisticated people that were already our customers, they already said, listen, we know what you guys bring to the table, so we want you to do this directly to us. There were more and more such people, and they were not being served by the other PMSs.
Yeah, we have not spent anything so far on marketing, advertising, whatever. Everything comes from referrals or from, premium clients want to upgrade to a PMS. Sometimes they're both, they're PMS customers and they're premium subscribers.
And what's also interesting is or fascinating is that there's a sense of community inside of the PMS and inside of premium as well, where we are very open about. Many PMSs are very paranoid about their customers talking to each other. Oh, yeah, he will reveal my portfolio. We're like, reveal my portfolio. I don't have a problem. Because, what are you going to do? You're going to buy more of it? That means my portfolio prices go up? Fine. I mean, that's perfectly valid. But, this concept, I think that differentiates us as well as the pricing. So, a portfolio manager in India is allowed to charge a percentage of profits as a fee. So if I make 100% for you, then I'll give you the first 10. It's called a hurdle rate. And then the remaining 90 is how I will charge you 20% of that 90. So I'll charge you 20% of profits, but I'll also charge you a management fee of 1 or 2% of the overall 100 that you were running it. And then I'll also charge you an exit load, an entry fee, a lock-in, whatever you may have. The lock-ins are not allowed, but you can charge a bunch of other fees as well. So now you're looking at this and saying, listen, this is a high fee model. And why can't we, if you're using technology to the kind of way that we can or we are, can we not reduce the fees quite substantially? We're not even using distributors, because distributors take 50% typically. Yeah. So if we were to take the low-cost approach, we don't need distributors. We can go direct to customer. We can solve customer problems. We can then get fees down to 1% management fee and nothing else.
So our current range, by the way, starts at 25 basis points.
Yeah, 0.25%.
For a passive-ish strategy.
Passive-ish strategy, and then all the way up to 100%, 100 basis points, which is 1% for an active strategy. This is probably the lowest cost PMS in India. And it at 0.25%, I would say it even one of the lowest cost mutual fund kind of, even compared to fees and mutual funds charge. But we have some disadvantages compared to mutual funds.
Just taxation.
Of course, there are taxation. We'll come to that. I think we'll do more on it.
But before we move on, this part about fees, there's this other thing that keeps coming up. And we got a lot of these questions when we started is skin in the game. Tumhara skin in the game kahan hai? Performance fee nahi loge, then if you're not charging us performance fee, how is your interest aligned with my interest?
Yeah. I love this, because we thought so I always think of this as there are always two ways to look at a problem. First is the way you think is right, and then the second one is once you do that thing that you think is right, you realize what is really right. So it's a second order problem, right? So let's say the first order is you think of skin in the game. Oh, you have skin in the game. We'll make money when you profit. We'll also charge you a management fee, but that's different. But we will make money when you profit. So I will try to maximize your profit. Answer actually doesn't work out like that. What happens is the PMS manager gets maximum enthusiasm to do take as much risk as he can, because he doesn't participate in the downside. What happens if he loses money? You take your money out and it's over. That's all.
You anyway charging management fee anyway.
Yes, he's charging a management fee anyway. But if you make money, he's going to participate on the upside. So there's an incentive to take a lot of risk. Now, also what started to happen, and this is something we realized in 2008, a large mutual fund, whose name starts with F, actually had a PMS product in 2007. And it was very heavily sold, and people thought this name, which is an American / British name, fantastic and all that stuff. And they had a PMS which fell 80% in 2008, because of course risky stocks in a market that fell 50% will fall 80%. Now, when you fall 80%, your 100 becomes 20. Now you have to make that 25x just to get back to a point where you can charge a performance fee again. Remember, performance is only for performance from that 100 onwards, right? So if I give you 100, only if you make 120 can you charge me a performance fee. So if 100 has become 20, I need to get back to 100 to be able to charge you a performance fee in the first place. So what this particular entity did was to shut down the entire fund and said, here's your 20. I'm sorry, we're shutting it down. The next day they would call you again and say, we have a new PMS. Which now, because if I take the 20 that you have, and perhaps you can add a little more money onto it, I can start charging you the performance fee from that 20 onwards. And now my risk is a lot lesser because the market's fallen 80%. Of course, it's going to go up at some point. But the point was, you've incentivized the managers to do exactly this. Shut it down when the market falls, so that they can reach out to you, and maybe not you, maybe to your friend, and say, we'll start charging you from day one now, and as a performance fee.
And the marketing is awesome, right? If we only make money when you make money and so on. Like, our interests are aligned. Look, I'm incentivized to get you the maximum returns because that's how I'll earn my fees.
Yeah, and honestly speaking, so many mutual fund and PMS managers would rather have their skin in the game in reality. That means they put their money into their own fund, rather than try this complicated approach of saying, no, I'll make money when you do. Actually, what happens when you do this performance fee business is that the distributor makes money, because anytime a fee is charged, the distributor says, I want my percentage of the fee, which is 50%. So it's a way to incentivize your distributor as well, saying, listen, maybe I can...
Market upar jayega to zyada milega.
And look at the last year, 2020 to 2021.
Imagine this. Okay, let's take our example. Momentum in our portfolio, in our PMS, went up 100% plus.
Yes, in 2 years, 121. In 1 year, 100 plus.
We still made 1%. If we had charged performance fee, how much would you have?
We would have, let's say we charge a 15%. Just to give an example, we would have made 15%. Momentum is now 215, 220 crores.
Yeah.
And if performance of that was about, 60, 70 crores, because the sums would have changed over time, just the performance was 60, 70 crores. We charged 15, 20% of that. That's nearly 10 crores, which we would have charged, versus us making just 1.5 or 2 crores, a little bit less than that.
We by the way, we didn't make 10 crore for the whole year.
Not exactly. And we're basically playing the long game here. We're saying, if we make you money, you'll stay with us. If you stay with us, we can be here longer. We can show you how these strategies work over the long term. And what we call momentum, what people think, stocks thoda sa upar chala gaya and you're out, is actually a long-term strategy. It's not a short-term strategy. It's a way to actually build your wealth for the longer term. Even though there may be a lot of transactions, it does not mean... So the shop doesn't make money by keeping a bottle of shampoo for its customers for the whole year and saying, I'll sell you a mature shampoo. He makes money if the shampoo moves, and then he gets another shampoo, and then other shampoo moves, and then so on. So in a way, sometimes the money is made just by overtime, because we don't make any money from transactions. We do not own a brokerage. We use an external third-party brokerage, which gives you the cheapest rates that you could ever get in any, to the point where a mutual fund would look at us and say, how have you got these kind of rates? Because for them it's shocking, but we have built it in such a way that our broker and our custodian, we use a custodian, we'll talk about that, have the least amount of effort, because all of their work is done through technology.
We do all the
that
work.
we
We
do.
don't rely on any third party to do any work.
Yeah, we well, sometimes we have to do the work of the third parties for themselves, but we'll come to that a little later. It's a pet peeve, but we've said right from the beginning that, listen, we will not leave any stone unturned to keep the costs as low as possible, so that we don't have to charge you, because I don't want to make a loss on this, but I definitely don't want to do it in such a way that I profiteer in a much higher way than other people. And in the long run, this is what makes money. Vanguard has shown it to us, BlackRock has shown it to us. We've just got to follow and stand on the shoulders of those giants, rather than stand on the shoulders of the giants of India, who've been charging you 2% plus 1% setup plus 1% annual fee plus something else. So I think that is where our long term focus is. And coming to the point which you actually mentioned, I mean, what what made us do this was this thing that said, listen, we've been proponents of direct plans, but nobody sold direct plans. Now we could sell it and make money. Otherwise, if you sell a direct plan of a mutual fund, and we were charging a smaller fee, I think at the time, for debt funds. Some of it was roughly the same rate, but the idea here was that you were charging for a service that included direct mutual funds and included stocks and included a way to balance the two, get an SIP, automatically manage it, target longer term goals, and do the whole thing without resorting to things like profit sharing, over trading, and all these concepts that we were otherwise little bit. I mean, we were against it. We were against it ourselves. It was just
And
not.
our customers, they the way our customer profile is, most of them are not coming to us like, oh, you are the best stock pickers in the world, or मेरे को ये वाला strategy ही चाहिए, maybe for momentum. But I think what they do by going to a PMS is you're outsourcing discipline, because otherwise on your own you might keep jumping from one strategy to another, one approach to another, and you might not get your asset allocation right, and अच्छा अभी कितना cash रखना चाहिए नहीं रखना चाहिए, you'll be making all those decisions. So you're basically outsourcing all this decision making to a portfolio manager.
Yeah, in fact, I think that point is greater than any of the stock picking expertise that I've ever seen. Because if you look at the concept of portfolio management, even on your own, if you're trying to build yourself your own portfolio, you might think, I have to pick up the right stocks. Nahi to nahi hoga. Right stocks at the right price. Otherwise, I'm not going to buy it. But that is wrong. It doesn't matter what the price is sometimes. You can buy a great stock at a higher and higher and higher price every day. When you do an SIP, the mutual fund picks stocks, its NAV is going up. You're buying more and more of it at the same price. Why do you think that will be okay, but you still have to buy all the stocks at a low price? I think the idea should be the discipline of identifying great stocks is one thing, but the discipline of participating on a consistent basis is a much more difficult process. Stock goes up 30%, your first thought is, प्रॉफिट बुक कर दूं क्या? एंड प्रॉफिट बुक कर दिया, ठीक है, अच्छा प्रॉफिट बुक कर दिया, आई एम वेरी हैप्पी, आई पेड सम टैक्स, ये वो, एंड नाउ द स्टॉक कीप्स गोइंग अप. Will you put your money back in? Answer, many times no, but the 10 or 100
this is the question you've kept getting on one of our stocks,
Garware.
Garware.
Yes. Yeah, it's that stock, it was when we first identified it, this was before the PMS itself, was at 195. It was a small cap, 300-400 crores at the time. And we said, okay, let's buy it. And then it was 350, and we said, okay, no, this is a great longer term story, let's put it in a long term portfolio. 350 became 500. People said, it's at 500, will you buy it? Why will you buy it now? Well, you buy it because it's a good company. It became 1,000, and it paused at 1,000 a little bit. People said, how can I buy at 1,000? Isn't it at a new high? I said, okay, it's at 3,000 today. We've got this question on Slack. You can literally search for it and say, is it too high to buy? And that lit stock is always going to figure, because no matter when people have asked this question, it has gone up another 10% from there. And now it's at 3,000 plus. So it's an interesting story of saying, listen, we don't know whether this stock is going to keep going up. I have no idea. But all I know is that the discipline of buying was the one that made the money. If you didn't have the discipline, you would allocate too little to the stock. And if you have a 1% stock that goes up 5x, you've made 4%. If you have a 3% stock that goes up 3x, you've made 6%. Literally, it doesn't matter how many x it goes up, it matters how much you've invested in it and how you've consistently managed to invest more in it over time. As you've gotten more and more, sometimes it's just a matter of conviction, sometimes it's a matter of, listen, there's nothing wrong with this. And when something is not wrong, I can put some more money in, because my net worth, because of my incomes and my savings, is going up. If I had to retain a stock at the same percentage of my net worth, then actually I have to invest more in it every month. This concept is very difficult, and when you outsource it, you take that thought process away from you. You say, well, even I outsource discipline. To be honest, I don't invest on any stocks on my own. Of course, some of it I may not be able to because I'm a PMS manager, but I actually invest all of my savings into the PMS, saying, listen, I will not be able to
No,
do this
as
kind of
as
decision making.
professionals in this field, in investment management field, even you would not have the time to actually buy stocks in your own account and keep track of them and so on.
And even if
Better
I
done.
did,
It's more efficient to do it through the PMS.
one is it's sufficient. Second is I have a problem mentally. I have personally those same problems that I'm talking to you about, which is this too high to buy? I just bought it last month at 500 rupees. Now it's at 700. I have the same thoughts for my own money. It's like a doctor treating himself.
So okay, let's compare this. You are, say before the PMS, you would have bought something. Now as a fund manager, you just make a decision whether to buy this stock and how much to allocate to it.
Yes.
By not doing the transaction yourself, and that the system does it and the organization does it, how much of a benefit that is versus buying it
I
yourself?
can tell you this, my portfolio, and because it's not just because of the portfolio, but I've been adding stuff. And I have a certain amount. I have about 15% of debt in my portfolio in the PMS. It's up over, now about 40% this year. That is calendar 2021. Not just because of the amount that it's gone up by, but also because of money that I've added to it. And it's probably half and half, a little more than half and half. But the problem that I had was, every month, if I had new money, I would have to now think of which stocks to buy. I could buy more of the same stocks, or I could buy a new stock. If I had to do this at my personal portfolio level, I'd be like, yeah, I have to research all of this again and find out, okay, let's say I do find out. I'll under allocate to some stock, over allocate to some others. I will make the stupid decisions like, I think this stock is not going anywhere. Let me get out of it. Let me buy something else that's going somewhere, without having a systematic thought process around it. At the PMS, I just trust because when I look at the stock list as a PMS, and I think, are we in the right place of where we want to be, and do I need to change things? When I'm looking at that, I'm looking at the overall portfolio as if it's a fund, rather than looking at it as each individual person. Does he deserve to have reliance in his portfolio? I don't know. The answer is, I have to have a standardized approach to looking at equity. Let the system do all the rest of the groundwork. How much he has to allocate to equity versus debt, how much of that equity needs to go to this stock, is determined by the system. And the beautiful part of the whole thing is, it just works. In the end, that it just works makes your life that much easier. Mutual funds do this very well. They've demonstrated to us that if you just continuously do an SIP inside a fund, it may not be the most optimal strategy, but it's more important for you to save and invest the money than it is to target the higher returns. If I can make 10% lesser returns, but it gives me the happiness of being able to invest 100 rupees every month, and I just stick with that discipline, it would be greater than me finding that little percentage higher return, but not investing 100 rupees for 8 months and only investing it for 2-3 months. I'll get a higher percentage return, but at the end mein, your pocket matters. It's not how heavy is your wallet matters more than whether your wallet has a shiny exterior, right? So it's
So it's interesting because you mentioned mutual funds, and maybe here's a good place to compare a PMS versus a mutual fund. So in a mutual fund, the mandate for the fund manager is basically, you have given me money, I have to invest. I don't care, and I don't even know that what is your financial situation. Should you have 20%, 30% cash, or what? I don't know that. So basically, you've given me money. My job is to deploy that money in the strategy that you've invested in. So if I'm a flexi cap, then I will go and buy these stocks, and that's all I'll do. But in a PMS, that's where it's different, right? You can do asset allocation decisions.
Yeah, I think two important things here, or three or four. Mutual funds have one advantage: they are not taxed in your name. Uh, we'll come to that. But let's look at the PMS's conceptual understanding. First, you give a PMS money and they can choose to deploy it in different kinds of assets. And that asset allocation can be determined entirely by the PMS manager. So it can be 80% debt one month, 20% equity that month, 75% equity the next month because the market's fallen. This is completely left as a discretion of the PMS manager. Mutual fund manager does not have that discretion. He's like, listen, I am.
And you're bound by the rules. The
Yeah.
SEBI has said, say, you can't go below 65%
Yeah,
equity
you're-
or 80% in, more
Large
than
caps or
20% in mid cap, small caps.
yeah,
large
and
cap
they
funds.
determine who the large caps are. So you get the universe of 100. It's almost like saying these are the ingredients make. I mean, it's like master chef at a mutual fund level. I mean, really, this is all the ingredients you have. You can't do anything more. I mean, you can't take anything more. And then you decide between that. So you're working on this little. So it's like saying, listen, I am going to run with a helmet and a full, space suit, and I'm the fastest runner over here. It's great because mutual funds do it consistently well sometimes, but they have these restrictions which PMS managers may not. So, for instance, a mutual fund manager cannot buy more than 10% in any one stock. A PMS manager can have 50% in a stock. It's legal because it's allowed. Now, same thing, a mutual fund manager has to do a certain set of things. He has to vote on because effectively he's the owner of the stock. The mutual fund manager has to vote in meetings and all that stuff and to keep a record of all of this. A PMS manager does not. The ownership is yours. So PMS manager may choose to inform you about it, but these rules and these kind of things don't apply to a PMS manager. But also, a PMS manager can do a few things, which is go to cash. 65% equity is required both by the income tax department for mutual funds, but there is no requirement on a personal level that you need to be 65% equity at any point in time. Why do you have to be 65% equity? In the time that last year when the market fell so much, momentum was at one point 80% cash. You can't be 80% cash in a mutual fund. All hell will break loose. SEBI will probably, shut down, lock your office and go away. But this is not the same as PMSs. PMSs can be in as much cash as they want and go back into equity whenever they want. They have some common rules. So, for instance, when a PMS buys, it has to have the cash in the bank account, which means that I can't sell a stock and buy on the same day. I can sell a stock, I have to wait for 2 days for the cash to come, and only then can I buy it. So you'll need some buffers to make things happen the way individuals can do it. Second, a mutual fund and a PMS cannot lever themselves, which means I can't buy a future or an option of Reliance simply because I think I want to participate in its future, because the rule is that your gross exposure, cannot be greater than the amount you've invested, which means I cannot lose more than I've invested at any point in time. So margin trading is only allowed to the extent that your overall exposure is limited to the amount that the customer has invested. This is the same whether it's a mutual fund or a PMS. By the way, in Capitalmind, we don't do any futures and options, but I'm just saying that this is a limitation that, future put Capitalmind and others things are. The mutual fund taxation is very efficient. So what happens over here is that the mutual fund can buy
That's
and
one
sell
big
stocks.
advantage they have, but now even long-term capital gains gets taxed. So it kind of shrunk a little bit. But
Yeah.
maybe if it's not a very high, very frequently traded portfolio, then the difference is very little between a mutual fund and maybe doing it yourself or via a portfolio manager. But if it's a very high churn portfolio like Momentum, that's where the tax efficiencies really come into play.
And I can tell you this. I've been looking at mutual fund portfolios for years. They churn. They churn the portfolio like crazy. It may not be as much as Momentum does, but don't tell me, you can't tell me that they don't do 35% churn. Some of them do 35%, some of them do 40%. There is a tremendous amount of churn. Sometimes they get in and out of stocks very easily. You don't realize it because you don't have to pay any tax on it. It's not in your account, it's in the mutual fund account. So the mutual fund themselves aren't taxed. And when you exit the mutual fund is when you're taxed. So,
well, tax is one thing. There's also the transaction cost, and one of the biggest component is STT.
sorry, 0.1%. 0.1% is what you'll pay as STT, no matter uh, whether you do one transaction or 10 transactions. The more transactions you do, the higher STT you pay. So to beat that transaction cost, just to get even. Now, mutual funds, by the way, do you know that your TER in a mutual fund, a total expense ratio in a mutual fund, does not even include the STT? So it means that if a mutual fund went and did a 40% churn, that means they did 100, they had 100 rupees of AUM, and they bought 40 rupees worth or sold 40 rupees worth. Um, you effectively have paid on that 40 rupees 0.1% as AUM. And if they bought another 40, that's another 0.1% that they've paid. That's 0.2%. That 0.2% does not reflect in the total expense ratio. So a fund can tell you, listen, our expense ratio is 0.3%, but actually they've spent 0.5.
Yeah, you don't like. I don't know other PMSs, but we give we show the expense ratio calculation, breakdown of all the fees and management fees, and you can, as a percentage of your average AUM, you can see that real expense ratio for you. A mutual fund is never going to give you an invoice.
In fact, that's a big problem, because all of the expenses that they do on your behalf effectively as part of a pool, but you never get that invoice and you don't know how much STT was paid. You can actually glean through financial statements of the mutual fund which they're supposed to give you, and I challenge you to try and find the STT separately. It is very difficult, in many cases impossible, because they don't reveal it, and they're not required to. So
Well, don't they just add it to the cost of the
they
purchase?
just add it to the cost, so you don't know what your actual cost was at any given point in time. I mean, so it may, I mean, this is legal, this is perfectly allowed, but what we said is, let's distinguish those costs from our buying prices and selling prices. So if I bought 123, I'm going to show you that I bought it 123 and that you paid this 0.1% as a tax.
Yeah.
Or a STT, rather than saying, no, you bought it 123.2. I could do that, but I think it's not fair, and that the STT should be shown separately. And I also feel that in the longer term, there will be a requirement for funds to reveal all of this. Now, in the US, if a mutual fund does a buy and a sell, the tax is on the investor. So if you're an investor in the fund at that time, that proportion of tax is yours. So you're supposed to file it as returns. That's the reason why in the US ETFs are so popular, because ETFs don't do a buy and a sell in the market at all. They just do a transaction with a market maker, which is a bulk loading of units, a transfer of units against a bulk portfolio of stocks. So it's not considered a buy and a sell. In the US, if you invest in a mutual fund versus an ETF, you are responsible for paying the taxes that are attributed to you when you buy or sell stocks. Now, this is very interesting, because at this point, India does not have this rule, and if this rule was ever going to come, and I don't think it will, because that will, it will destroy a lot of businesses, but this would make then the PMS equivalent to a mutual fund. But till then, the mutual fund has a taxation advantage.
This is interesting where you mentioned about the US thing. Even here, it's the same, right? ETFs, they don't buy directly in the market. They have a authorized participant or somebody who's buying the units. They get charged the STT. The fund itself is not paying the STT, versus an index fund has to pay the STT.
Which is why the index funds in India have a tremendous tracking error. And that tracking error is always negative. So you're always like 0.4 or 0.5% less than the index itself. The ETFs on the other hand are 0.1% less. And you're wondering why. And you're saying, okay, well, if it's 3 or 4 transactions that they have to do for rebalancing, that itself adds a 0.2 or 0.3% that will take away from the fund. But regardless, when we've applied to be a mutual fund, just to
Full disclosure.
for full disclosure, we plan to change this game, because this is a tremendous amount of cost, and we want to make it such that if you're an index fund, you don't care about the STT. I know, because you're like, okay, dude, just give me the index returns. I don't want to hear your excuses of STT and this and some balancing error and all that. My job is got to be to find a way to get you to the maximum closest to index return as possible, without without at any point doing something that would give you more risk than the index. So I shouldn't do things like saying I'll buy a little more Reliance so that I don't have to buy it tomorrow. That kind of stuff is not acceptable. But if I gave you the same risk as the index and I got you a better return, my total expense ratio can be 0.4%. It doesn't matter. What matters to you is after my expenses, am I closer to the
The
index?
true expense ratio.
The true expense ratio. And we should talk
What is
about
your
that.
tracking error basically?
Tracking error. And and the PMS we can't even do it because as a mutual fund you get a tax efficient vehicle. If I did the same thing in the PMS, you would receive the dividends in your account. That dividend would be taxed in your name since dividends are taxed now. Second, you would have the transaction rebalancing costs plus STT in your name. I couldn't do any of the optimizations that we want to do as a mutual fund in the PMS. But that's fine because the PMS is not meant to do that. But the PMS is meant to build personal portfolios for people and try to get them as efficient as possible.
So, since we're talking about personal portfolios, let's talk about how the portfolios in our PMS have evolved, and not just portfolios, the strategies as well. Because we started with only the long-term growth type of portfolio which you were managing, and then we added a passive portfolio, we added a momentum portfolio, and then we have these different strategies, different ways of allocating to these equity portfolios, and managing asset allocation, how to have debt and then move money slowly into equity and so on.
Yeah, in fact, so look at two things. I think when we started off, we said we should have one strategy, and that should not be something that transacts very often. So, or when I say transacts very often, it's not going to change stocks very often. Largely mid caps, interesting stocks. So we built a portfolio of stocks that was about 25 to 30 stocks. We said, okay, let's build this out and say, buy these for the long term. Over time, this is a very similar strategy to most mutual funds. Somebody is going through stocks, they're saying this is a great stock, we'll buy it. And I could give you stories of Agarware Fibers, which is now up to 3,000 plus. Or I could give you the story of something else which has fallen and, we exited that portfolio at some time. But the point about all of these things was that you were not any different from the mutual fund that you were competing with effectively but just saying that, listen, trust me, we can identify better
And then it
stocks.
becomes only a game of returns.
Yeah, it's, and in the end, the game of returns is often what people love to see in the market because they say, oh, you gave me better returns. But we've seen this. HDFC mutual funds, phenomenal fund managers were fantastic in 2007, 2008. If you looked at 5 years, 3 years, 6 years, any amount of data, HDFC mutual fund was absolutely the top return in equity portfolios. Today, 14 years later, 2021, if you look at any 3 year, 6 year, 9 year kind of returns, HDFC mutual funds equity portfolios, equity mutual funds are not even in the top 10, and they're not even beating the index. So, okay, we said, okay, HDFC was an aberration. 2013, there was IDFC mutual funds, great equity portfolios. Today, they're more well known for debt because their equity portfolios are languishing in comparison with the index also. So, what happens really is this game of returns is one for short periods of time. People make a lot of money, managers, I mean, when they highlight those returns. The longer term nature of those returns, sometimes you will not find as convenient. So, you have to build something that has a great, so I don't think people chase returns by, they want to chase return, they want, but in the end what they really like is comfort. I will deal with a smaller return if I believe that what you're doing is best for me. So I can tell you about a Capitalmind PMS is phenomenal return, but you might still stay with the PMS you're in because you're saying, listen, I'm comfortable, he's giving me 15, 16%. That's all I need. I don't care about you're giving me 100% or 90%, because I don't even know if you're a one trick pony, if you're a one shot winner, and after that you won't win again. This guy at least has consistently performed for me over time. So to build that confidence, and you have to have a much deeper strategy than just saying returns. It's got to be, some people solve it by saying, this is my philosophy, I buy these kind of stocks. And if you believe me, stick with me because I will only buy these kind of stocks. Again, now it requires a certain amount of sophistication for somebody to even understand what that means. Because most of our customers will come to us and say, whatever you say, because I'm not really going to go down that route and say, is this stock? But I mean, you looked at the I want a stock whose ROE is 24% and plus. Many of our customers are going to look and say, listen, if you say it's 24% plus, I believe you. Because I'm not going to go through those financial statements and say, this was 23, why did you buy it? And, so that's not, sometimes the philosophy is at some point, not just lost, but people are saying, listen, whatever makes it happen, I just want to trust you people. So you have to build that trust, and you have to, I think, also maintain the integrity that says we will honor it. But more, so here's the part of the portfolio that changed. We said, okay, let's target good returns, but also build the framework that is acceptable. So the first year or so, because of our mid cap focus, let's just say we shot ourselves by not doing the thing that we were really good at doing. And the really thing that we were really good at doing was being quantitative about markets. In 2019, suddenly, some light bulbs started flashing, and we said, okay, we can't be doing this when we are doing so much better with the quantitative strategies that we're offering our research customers, but we were trying to do the active, same mutual fund route.
And two things that happened. 2018 is when SEBI released the mutual fund recategorization, which meant that, and since then, most of the large cap space, the alpha has just vanished.
Yeah, in fact, in 2018, we started to discover this was happening even before, because a lot of funds which call themselves small cap were actually large cap. You could find a small cap fund with 20% allocation or 10% allocation to HDFC, 10% allocation to HDFC Bank.
HDFC is a cash position.
Yeah, it's a cash. It's like
liquidity chain, na?
So you build. So you suddenly said, okay, the SEBI came up and said, listen, you're a mid cap fund, you should have 65% in mid caps. You're a large cap fund, you have 80% in large caps. I will tell you what are large caps, and I will tell you what are mid caps, and I will tell you what are small caps. So now everybody has to, kind of make their reassign their portfolios according to this. What is now interesting is that because of this, the larger cap funds, and this is where about 80% of mutual fund assets reside. The larger cap funds were primarily investing in the top 100 stocks. There is no information arbitrage available in those top 100 stocks. And we started writing about it and saying, listen, why can't we buy index funds in India now that these new rules have come, but not just because of the new rules, but because the information arbitrage in the top 100 has already been lost. Let's look at the large cap funds in comparison with indexes, and lo and behold, the 3-year, 4-year, 5-year returns. 10-year returns were fantastic for the mutual funds. There was information arbitrage 10 years ago, and they've used that to their advantage. But from the 2014, 15, 16 time frame, that information arbitrage was lost. This is not political, but it just happened to happen during that time frame. But what we found fascinating was that a simple strategy and now this is where it gets very interesting. The Nifty 50 and the Nifty Next 50, which is the top 100 stocks in India, were already starting to beat most of the mutual funds. But you add another layer, because we were using Amazon, we were using Facebook, we were using Microsoft, we were using Apple. A lot of people are using Apple and paying $1,000 for a monitor stand. And you want a piece of that action, because I won't buy their product, but man, I want a piece of that company. You want that in your portfolio, because that is what we were using. I'm using stuff on an Android. We're recording stuff on a on a tool that was built by an American company, which is listed in the US NASDAQ. We're going to put this podcast on a tool or a video that might be on YouTube, which is a Google company, or a podcasting platform, which like Spotify or any of the others, which can be accessed using all of these companies that are listed in the US. And I'm thinking, at some point, we started thinking of this and saying, why can't we have that in the PMS? Now, PMS has to invest in Indian listed instruments today. We said we could use a proxy called the NASDAQ 100. There was one ETF at the time. And this ETF was listed since 2011. And we said, at this time, it's a great time to start investing in this for our customers. Take the top 100 US, take the top 100 India, and add this NASDAQ 100, which is top 100 US technology companies. The combination of the two, and when we backtested it, it was unbelievable that no mutual fund had been able to consistently beat this in the last 5 years. And we said, okay, this is interesting. Maybe it's because of the NASDAQ. But I'm saying even before the NASDAQ, we were seeing a considerable underperformance, just the Nifty 50 and Next 50. But you add the NASDAQ, suddenly you got to a whole new different level. This became the passive portfolio. A very peculiar thing had happened in 2018, I think, in November. Before 2018 November, the ETF could be bought on the exchange, but you had to pay roughly a 20% premium to its underlying NAV, which meant that so if you wanted to buy an ETF, you had to typically put a large amount of money. Motilal, who was the manager of that ETF, said, "Listen, you have to pay us 3 lakh rupees if you want the NAV, 3 crore rupees. Sorry, if you want to get the NAV."
Because they have a lot size to buy in that minimum
Yeah, so
quantity.
it was 1 lakh units and 300 rupees per unit at the time. So you have to pay 3 crores. Otherwise, if you want smaller units, please go to the exchange and buy. And if the NAV was 100 rupees, and the exchange was selling for 120. So, of course, before we started the PMS, the first thought process was, how can we make money out of this? So we went and we collected 3 crores and bought one of our and of course we can this thing that, but when we were able to sell that 3 crore
It was more,
number.
Deepak, it was I think 4.5 crores.
Yes, I think it was 450
or
or
something.
450 or something like that. And then we were able to sell all of that on the market for 20% higher.
Yeah, but if we had just held on, we would have made so much more money.
Yeah, that's the unfortunate point is, sometimes what works for an arbitrage suddenly works, more looks more. So we made that little bit of money and then we got excited. Then Motilal realized that this is a problem and that more and more people may be interested in that time. I think at that time the total size of this portfolio was just about.
It was less than 100 crores.
Yeah, it was less than
the
100
AUM.
crores at the time.
It's now 3,000 or
4,000,
4,000
yeah,
crores.
some crazy number like that. But what we did at that time was to introduce this in the Capitalmind PMS, the wealth PMS itself, saying this is a passive portfolio. And at the same time, we introduced the portfolio which we really, really identified with, which is momentum. The concept that a stock can go up and keep going up. And this is where, excuse me for, advertising our portfolio so much. But
No, this whole episode is advertising.
Yes.
We're
not going to mince any words here. Yeah. So, see, momentum, I think inherently is something that all of us are passionate about. And I think the reason we're passionate about it is so innately human that something that does well continues to do well for a while. And it's so innately non-intuitive. Because I can tell you that if Rahul Dravid forget Rahul Dravid, he's now an angry young man in Indranagar, but let's say Virat Kohli is in form, you're expecting him to go in every match and hit 100. And when he doesn't hit 100, you're saying he's lost his form or he may be losing his form. Let's give him a little bit of a chance. If he doesn't hit 100 in 2 or 3 matches consecutively, not even a 50, then you're saying he's lost his form. Now, we do this naturally. We don't have to explain it to anybody else why this is happening. We understand it intuitively. So, we also know that he's in form because every match or every second match he's hitting that 100, and you know that he's in form. So you talk to people and say Virat Kohli is in form, and it's not just Virat Kohli, it's like Roger Federer is winning. He's winning because he's like one of the best and he's the greatest of all times. Djokovic won because he's got this strength and he's always been winning. The point about some of the strength that these players get when they play is that their confidence comes from having won in the past, and that gives them that little bit of extra strength because it's not skill anymore. All these players are extremely skillful. Sometimes it's just the confidence, the mental makeup, and that little bit of extra energy that you get from the confidence in the core that makes you happen. Now think of this in stocks. If a stock is going up, all its customers are seeing its stock price going up. They're saying, your company must be good because your stock price is going up, and the managers of the company are feeling like they're telling their customers, look, our stock is going up.
Like
We're doing
people have
really well.
recently discovered CDSL, BSE, and CAM as platform businesses.
Yeah, I mean, yes, you're right. It's not like they weren't, but suddenly looking at the data and saying, listen, we've got 35 lakh new accounts started in the last 3 months. Who's going to benefit? CDSL? CDSL is great. So CDSL guys are thinking we must be doing something right. It may just be that there's euphoria in the market that's giving them what they are. The point is that confidence gives them the ability to say, let's try new things. And that let's try new things results in more business, in more scale. So this is a downstream effect of it. But looked purely upon from a point of view of prices, there is an information asymmetry in the business, which means that there are some people who get to know about some news earlier. They may be because they're in the trade. For instance, if I'm in a if I have a hardware store and suddenly I find that my orders for Fevicol have gone up 5x, I talk to a few people in my trade and they say, people are Fevicol's flying off the shelves. I will go and buy a Pidilite. I am not an insider. I am just a guy in the trade. I'll say, Pidilite, the stock will start doing well because it's. So he gets to know that information first. I get to know the information second. By the time I got to know the information, it's probably like because my friend's friend was a hardware dealer and I buy this stock, I push the price up a little more. Then somebody in the TV channel say Pidilite's price is going up. Why? And the TV channel highlighting that is enough for 100 other people to say, hey, Pidilite's price is going up. Maybe people are buying Fevicol. And, so the thing about momentum is it's a positive feedback loop on the upside. Now, what happens on the downside? You might say, hey, Deepak, prices will go up, but they'll come down also like that. No, somebody says there's a fraud here, then everybody says there's a fraud here. Answer is this. When it goes up, you can make 100%. But what if you said, I'll limit my losses to 25%? That means I will not let a stock hurt me more than 25%. If it falls, I don't care what the Fevicol is selling or not selling. I don't care if it's nobody, if hundreds of people are still buying Fevicol. If the price of Pidilite's share falls 25%, I am getting out. Because what will happen then is it will get out, and then if there's really a problem in Pidilite, then Pidilite's price will keep falling, and then you'll get some news that something is wrong or something like that. And that's when you'll say, oh, well, I don't know why, but the price was already going down. I just sold. The point of selling and cutting your losers first and keeping your winners, letting the stock multiply 1x, 2x, 3x on the upside gives you a little bit of an edge. And all you need in the market is a little bit of an edge. If you do this consistently, what will happen is the first 5 or 6 months, you may buy 20 stocks. You may sell 5 of those each month. There'll be a different 5. Each of those, in the end, you may have only 5 or 6 stocks that you actually held for 6 months, then the rest of them are relatively new. But those stocks which you've held are starting to give you great returns. The longer you hold a stock, the more likely it is to be profitable for you and to be immensely profitable for you. We've seen stocks that have given us 300, 400% in 4 months and then quickly vanish from our portfolio, then come back in. This is the other part about momentum that's attractive, is because it gives you the discipline to say, I don't care if I sold this stock 20% below this price. Because if I sold a stock at 180 and now it's 230, your thought process is, I'll let it wait. I just sold it for 180. How can I buy it at 230? The answer is you can. You just hit the buy button. At 230, you shut up and buy. Because when momentum is on, it doesn't have or need to give you a reasoning. We knew this because we have run this in the Capitalmind portfolios. We have seen this as a portfolio. We've seen this done across a diversified number of 30 instruments. And we said, let's actually do this for customers. Maybe this is actually the redeeming thing, because this long-term multi-cap may take a long time. And to be fair, long-term multi-cap now over a 2-year period has actually done better than the index. But for a long time, it didn't. It took some time to come back to it.
But there is a learning curve, right? You're all portfolio managed or fund managed for the first time.
Yes.
So you have to learn
the
how
art
to
of
construct
the
the portfolios, how much to allocate to what, how to reduce allocations, how to get something out, and so on. It's a learning curve for you as well as Anup, who's managing momentum. When you started, you started with 5-10 crores in AUM. Now it's 200-250 crores, whatever. So you can't really go and buy all the stocks that trade 1 crore, 2 crore a day.
Yeah, we can't. No longer can you. So, for instance, the same rules don't apply. And also, we've discovered that, over time,
in the PMS, you really don't want to get stuck with something like an ATGL or whatever.
Yes.
Even though it was a very liquid stock.
Yes. At some point it was, but we were looking at the patterns and saying, upper circuits, I don't want it. Anup was actually saying this. I love this stock, but I can't take it in the PMS because it has upper circuits, which proved very well, because when it had lower circuits, we didn't have to get out of it at that time. But what is interesting from a learning perspective was that these portfolios, although they required action from us, the passive didn't, of course. Passive was just buy, and
we can buy efficiently.
We can buy more.
We can buy directly from the fund house and don't pay the premium on the market.
Yes, and we end up paying a lot lesser premium than anyone else in the market because we adjust our buys over time. Sometimes there are people who come and sell that ETF because they want liquidity. They end up selling at lower than the NAV. We are able to purchase those stocks at lower than NAV and average out to a point where your average buy price is much lower. The good thing about some an approach like this is you outsource that discipline and you also outsource the time because it takes a lot of time. Somebody sitting and looking at this price NAV. The NAV changes every 2 seconds. Okay, so you have to look at an SBI website or a Nippon website and say, oh, this is now 48 rupees 30 paisa. My order was 48 rupees 20 paisa.
Well, you can go and buy these index funds or fund of fund, but then their expenses are higher.
Yeah, their expenses are 0.5% a year higher. So in 5 years, you pay 2.5% higher. So I'm like, listen, I'd rather pay 1% one time than to pay 2.5% or 0.5% every year. We found that much more redeeming, from a portfolio perspective. We added one more layer on this. Now we go to other PMSs. They have three strategies. They say 25 lakhs per strategy, which increased to 50 lakhs in 2020. So if I had only 50, why can't I get a taste of all three? And we were like, there's nothing restricting us from doing it. And anyway, a PMS is personalized. So I could offer you some of one strategy, some of another. I was anyway doing it because we were saying, you could take half your portfolio in debt and half your portfolio in equity. That was
Even goals. People said, ki, look, this is retirement.
Yes.
So I can take a little more volatile strategy here because I'm invested for like 20 years. And versus say much more like a goal that's 5 years from now, you want much more safer things. You'll only do say a debt equity between debt and only the passive portfolio.
Yes. And so now you get more and more towards interesting rules. So for instance, one of the rules could be if you've never invested in equity before, don't give these people taste of a long-term multi-cap, which can be volatile and require you to think for longer term. Don't give them only a momentum strategy, which they might not understand quite easily.
And mind gets scared with all the SMSs coming. Ki, Arey, this got sold, this got bought.
This got bought, yeah. So you want to avoid that. So you say, okay, listen, let's do the passive strategy for you. You last this through for 6 months, get a feeling of it. I'm in top 100 India plus top 100 US. So I feel a lot more confident that you will be, this is not a portfolio of dead stocks. And I'm always in the top 100. It's not like, if Yes Bank was in the top 100, that Yes Bank went out and some other stock, HDFC Life, replaced it. We didn't have to do anything. The ETFs automatically did their task. So that's a good starting strategy. So it's almost personalized at a risk level as well. Saying, even though you may, so some people come to us, they may be more than 70, and they come to us and say, Deepak, we don't have any long-term thinking. We just want to allocate some part of our money to equity. I have enough debt where I am. So we say, okay, don't do goals based because you don't need to plan. You're retired. You don't
You
have
just
kids.
need a way to deploy some of this money to equity
And
without taking any risk on your capital.
yes, without. So this is where it becomes interesting because we can actually do a strategy of a combination where we can say, listen, take your core capital and keep it in a debt fund. Slowly trickle the interest portion of what you earn, because it's the capital gain portion of what you earn into equity. Over a period of 5 or 10 years, you will become 30% equity just because of the nature of the game.
And it's highly tax efficient versus doing the same thing in an FD because
well,
of the magic of first in, first out.
First out. So more than 80% taxes can be saved. You'll pay 80% less taxes if you did this with a debt fund and a approach to move to equity. What's also interesting about this approach is you won't hurt when the market falls because at any point only the equity portion is impacted. The debt portion is relatively safe in comparison. Of course, we chose safe funds also. Funds with short-term government securities or funds with PSU and banking exposure. So there is some risk over there, but not quite as much. So what we decided was that, so we actually had a few customers who said, listen, we like this strategy, let's take it. This customer didn't even realize that the market fell 30% in March of last year, or didn't realize, but didn't see the impact on their own portfolio. They were like, oh, we fell 2%, that's okay. Because when you have a 10% equity and the 10% equity falls 20%, the eventual impact on your entire portfolio is just 2. So you did a combination strategy of debt and equity with this dynamic movement. We called it preserve. So we are one of the only PMSs to have a strategy that says, listen, we can try and build your long-term equity exposure without affecting your core capital, and say that we'll try and preserve the capital while we give you equity exposure with the returns.
And it is especially important to people who need that capital to be safe. Like, I have done this for my mom personally, because when she retired, her corpus is not large enough that it can sustain entirely just based on debt. So you need a little bit of equity exposure. So I said, give me half. I will manage that half portion for you. And the half, I just plonked it into debt funds. And every time the capital gains become 1 lakh, I just take it out and put it into a mutual fund.
Perfect.
And in 4 years, it will be just 4 years and a couple of months, she's already at 30% equity.
Yeah, and that's
Because
also,
markets are, it's timing worked out, but still.
But it's brilliant.
And she doesn't need more than like 40% equity overall.
Yeah, and what will happen now is, even if debt returns were to collapse, the equity portion of the things curve is giving you supernormal returns, like we were talking today. And today is a very interesting day, because today itself, one of our portfolios, Momentum in this case, in the PMS, earned literally half of an annual return of debt fund. Most of the debt funds. Debt funds are yielding 4.5%. One of our portfolios up 2.7% today itself. And we're like, my God, there's such a big difference. But you know what? If you don't participate in equity, you're not going to see this kind of return.
So this is a safe way of participating.
In relatively interesting, because when the equity markets are down, they won't hurt you as much. But you'll get a little bit of participation on the upside when the markets are going frothy and crazy like times like they are today. I would say a balanced approach like this is far more acceptable. And if you look at it, and we created this, right? We said, let's do an NAV as a whole. So you can see your portfolio as a whole and say, Deepak, don't show me debt or equity or anything like that. Just tell me how I've done. And I can show you. I can show you how you've done as a whole. This is similar to investing in one mutual fund. But nobody invests in one mutual fund. People invest in 5 mutual funds. How have you done across those 5? You've done different SIPs. You've stopped the SIP in one and started the SIP in another. You have some units of the other. You don't know how much you've
This
done.
is our typical sales call. Yes. Where a lot of people say, look, we have this portfolio of mutual funds, and then we try and do some analysis. It turns out that, and we just compare it to our market index, yes, the passive portfolio, and see, look, you overall you've underperformed this. So why do you want to pay 1%, 2%, whatever, to mutual fund of portfolio mutual funds of 10, 20 mutual funds, instead of just do the simple thing?
Yeah, which actually is quite remarkable, because some people, of course, they may not know how much they've but what they haven't seen so far is how have their portfolio of mutual funds done as a group rather than each individual one. Because at any point in time, I can give you a portfolio of 10 mutual funds. You'll say, hey, these 5 are good because they've done better, and these lower 5 are not good because they've done worse. But you can say that for any 5, because if you take the same 10 the next year, it will be the bottom 5 that may be become the top 5, and the top 5 become the bottom 5. So you'll always have 5 good ones, 5 bad ones, almost always. Which also means that no matter how you look at it, you have to look at your portfolio as a whole rather than as individual pieces. The only people who do allow you to do that are perhaps some of the new age startups, if you buy those mutual funds from them. Not if you've bought it already, you already have it in your portfolio and so on. So we built, so part of the technology that was there in the back end was also to show you your portfolio as a whole, and then also as subparts. So
we are also the only PMS in the country to show daily NAVs publicly for all our portfolios.
Yes, and we the performance disclosure is daily. It is an API. You can build your own charting system if you want.
Please don't say this. Venki will go mad.
Yes, I think yeah. I mean, you could build. I mean, you could read it, of course. But the big thing about this is that the system that we've used allows us to do this in a very transparent way. Now, we also, for instance, if you're a customer, you'll be able to see your portfolio on a daily basis. That means yesterday evening's portfolio is what you see now. Many PMSs will not allow you to do that and show you only something that is...
Or a statement once a month or once a quarter or something.
Or something like that. And they'll show you something that's like 15 days old because they don't want you to see the list of stocks. And I'm like, why? Unless I'm buying the stock... you own the stock.
I mean,
You
there
are
are PMSs who don't even when they create a demat account, they put their company's phone number and email address there instead of
Yeah,
the
this actually
customers.
this is where I think we can segue into how PMSs operate, perhaps.
Yep.
So there's a interesting part of this, but before we get into that, we'll also talk about deployment strategy. So one of them was preserve, which was this thing. There was asset allocation, which is stocks and debt and portfolios like that. The last part of a deployment strategy that we have is something called scaling in. So, which is like saying, listen, give me the money, we'll scale in over a period of 6 months, and you can even add an SIP on top of that. So, we'll take care of the whole thing. We'll move from debt to equity over 6 months. You can keep adding money in the middle, it will automatically get deployed. Some of that money will go into equity, some of the money will go into debt as a consequence of how your goal based plan, or you could have a rules based plan that says I want to only have so much in momentum and so much in passive, and it will get spread between the two based on how much ever whatever rule we've created for you. So we're one of the few people that say the deployment strategy is partly under your control, but we have a fully automated system that says if you don't want to do it, we have an algorithm that will automatically allocate to every pool of goal, we call it, that you have, and that goal could be pure momentum, pure index, or 50% index, 50% debt, and it will automatically allocate to these goals based on certain rules that we've predefined. So we spent a lot of time thinking through the tech, so that we could offer the most flexibility with the least amount of complexity to the customer. The idea is we could have done a lot more. I could have said you can put 10 paisa here and 15 paisa. I mean, all that stuff can be done, but I think we said, okay, let's simplify it as much as possible and keep it clean and easy to do. But now let's go back to how do PMSs actually work?
How does it work? What all documents do I need to sign? What are the players involved? How do you keep track of cash? Fees कैसे होता है? How do I transfer money? What about anti-money laundering? What about taxation and all those things?
This is very interesting. So let's start with the basics. Okay, so you have to think of, I'm going to talk about the PMS industry as a whole, and then I'm going to talk about what Capitalmind does, some of which is slightly different from the industry, but still. So the first thing that you have to do when you start creating an account is you have to assume that the PMS itself is going to have to create a new demat account in your name. Now I'm talking about discretionary PMSs, which is about 90% of the PMSs in the country. But there are lots of non-discretionary. They might be able to handle your existing PMS. Now earlier it was possible for you to have run through a demat account without a custodian. Now, but since 2020, the SEBI has changed the rules. By the way, we started off, even though we were less, we could qualify to not use a custodian. We started off with a custodian. A custodial approach was 100%. Is basically a concept where you say that all your transactions are run through somebody who is actually not the PMS manager himself. So I make a decision on that we should buy a stock. We may trade in a brokerage to buy that stock, but the stock should be managed or in the custody of some other entity than me. There's a reason for this, and a good reason for it is that it's possible that a person who has custody could misuse that opportunity and try and lend out that stock or do something else with it. We said SEBI has said this right up from the front that we want to reduce the risk of any of that happening. So they've said you need to appoint a custodian. Now, custodians are not new. All mutual funds use custodians, all FIIs use custodians, and of course, many trusts use custodians. We said we'll use a custodian from the start. We chose ILNFS Financial Services, unfortunately, and we'll come to why that was unfortunate. But they were a much bigger entity than we were. Of course, they were more popular.
They were the biggest custodian.
They were the biggest. They were the biggest custodians in the country. So we said, okay, let's go with them. And everybody, including Zerodha, was using them as. Of course, they were not using them as custodians, but they were using them something else.
No, before they were using their demat before Zerodha launched its own demat.
So they were actually quite popular among the. So what we did was so you had to open a demat account. So the demat account provider, in this case ILFS, would give you a set of forms to fill. This involves a KYC and proof of address, proof of identity, all of that stuff. On top of that, there would be a power of attorney allowing us, that the PMS manager, to be able to buy and sell stocks on your behalf. we could then this power of attorney needs to be signed. And at that time there was another rule of SEBI which said every customer has to fill a form saying I understand that this is the risky thing, and they'd write it in a handwriting. So at which point, people, first of all, they don't even sign checks properly. How do you expect them to write like entire sentences with legible format? So, but that was a rule. You had to do it. So you get a booklet of forms that you have to sign. That booklet of forms will come to you, and then you have to sign them, and then go back. It goes back from the operational process. Now, there are two kinds of PMSs. One is a PMS that says, I will open a bank account for you and a trading account for you, and trade in that trading account, in that bank account, using that bank account's balance for you. Now, this is a kind of PMS where the bank account is opened in your name. All dividends come to that bank account. All money that you transfer to that bank account, but you do not control the bank account. The bank account is controlled by the custodian, who gets a power of attorney to control it. And then they can debit that account with whatever and so on. This is a trading account. Now you have 500 customers. You have 500 trading accounts and 500 bank accounts. This is how a lot of the PMSs in the country operate. The rest of them operate on a different principle. It's where they say there will be one custodial bank account, single. So all funds of customers are commingled at that one point. But those funds are used to buy stocks which go into individual demat accounts. So you will have a demat account for each customer, but one custodial bank account that's not managed by you, it's managed by the custodian. But the custodial bank account is where all dividends come, and of every single customer, and all proceeds of all sales come, and so on. Now, what's the difference between the two? The point of having different demat accounts and different trading accounts.
Is this also account where customers transfer their money if they want to invest more money?
Yes. So they have to. This is actually not. No, it's not. And so
it's different, right?
It's different. So what happens is the PMS provider is the only one allowed to transfer money into that account. This custodial single bank account that I talk about. But what you do is you transfer money to the PMS provider like Capitalmind, and Capitalmind then has to transfer to this particular bank account. It's called the custodial bank account. There is a reason for this. If they transfer it directly, that account is not under the control of the
custodian.
Well, it's under the control of only the custodian. So, for instance, if there's a custodial bank account, I cannot debit that account. I can only transfer money to that account. I can't transfer money from it. Only the custodian can. When people transfer money to it, the custodian says, listen, this money is not from the person we have a relationship with, which is directly the PMS portfolio manager. Now, who is this person who's transferred money to us? It becomes very confusing for them. They say, you guys maintain that account. You transfer money to us.
There's this whole anti-money laundering thing that you have to take care of.
Yes. At this point, we have to take care of the fact that this money has actually come from the right account. We have to be sure that...
And it can only come from somebody that... We can only accept money from somebody we have a relationship with. It's not like you are a customer, but your money is coming from your wife's account or your cousin's account.
Cousin's account
like that.
And all that. Because we don't... If that comes under the scope of money laundering, then... we and you as a customer will both get impacted. So we want to have everybody has to have a process. Many PMSs don't follow this as a process very strictly, but this is how it has to be done. Now, the next part of this operation is, now what do you do? What's the difference between having individual bank accounts and individual trading accounts versus one bank account, one trading account?
Okay, let's recap. So there is one account where customers can deposit their money.
Yes.
This is not the custodial bank account. This is where they just deposit the money.
They deposit the money.
We transfer from here into the custodial bank account. From there onwards, only the custodian can debit that bank account.
Yes. From then onwards, we don't have rights to debit. We can see the balance, but we can't debit it. We can tell our broker, listen, we have so much money in that account. Can you allow us to trade, please? We do that. And then we say, well, let's trade. So now what I can do, for instance, is buy 100 shares of some stock. And tell the custodian, listen, when you get the 100 shares, can you pay for all the 100 shares through the single bank account, please? But let's maintain separately individual persons' bank balances separately. So we have a software to do it. If you didn't have a software to do it, other PMSs will use a software like Wealth Spectrum and the back-end technology behind it to segregate the cash balances of each individual customer on a virtual basis. The bank account may say you have 1 crore, but 10 lakhs belongs to customer X and 5 lakhs to customer Y and so on. So this segregation is done through a fund accounting software. We've written our own fund accounting software, and there are other commercial fund accounting software also available, which you can use. Now, when you do this, you say, okay, I've paid for 100 stocks. Who have you paid it from? You have to have the segregation of the accounts from which you paid for those 100 shares. So 8 shares of worth of money, please, is debited from this person's account.
And hence
so on.
8 stocks to be credited to that
To
person's
that
demat
demat
account.
account. So for instance, if I buy for you and me, and I buy 100 stocks, and I have to say 60 for you and 40 for me, effectively 60 stocks worth of money is debited from your balance, which is the fund accounting balance that is running in the software. And the custodian just pays for the full 100, and the fund accounting takes care of this. And what they do is, when they receive the shares, which is 2 days later, they transfer 60 shares to yours and 40 shares to mine. This is interesting because this is very different from the way some other PMSs operate. Remember, I told you there were two. The funds that created a new trading account. And so in those trading accounts, what you would have to do is, I would have to log into each trading account. I first buy in your account 60 shares, log out of your account, log into another account, do 40 shares there, and so on. Now, many of these guys, the PMSs use brokers who will then trade using trading terminals, where they will just say, we can switch the account, using a
Client
using a
code.
little click of a
Keep
button,
changing the client code.
keep changing the client code, and then do the trades differently. But you still have a problem. If a stock is going up continuously during the day, I bought 60 shares for you at 100 rupees, and then by the time I got to my account, I started buying 40 shares in my account.
So every client gets a different
price,
buy price,
which is lousy, right? Because if the stock's gone up 20%, one guy has made 20%, one guy has made 1% in the course of the day. If
in the same day, everybody's invested,
yeah,
but it's still
which is rotten. And what we decided right from the beginning was, what we're going to do is have a single average buy price, even though we may buy through the day, because we also won't buy all of the stocks at one shot. We will buy through the day, and everybody gets the average price. Nobody gets a preferential price. This is now enshrined in SEBI rules, saying you have to do this. But we decided right from the beginning that was the right, fair thing to do. Of course, I think that rule, of course, existed at the time when we started itself, but we, imbibed that into the software itself. And we decided not to create individual bank accounts, individual trading accounts for that reason. So we could buy in a combined way, sell in a combined way. Everybody got the same price. We got, and although it required us to keep a close match on balances, we set up a process to do so. Now, what happens in a process like this is that we have to make sure that the account balances match. So, for instance, if I have 5 customers, one customer is supposed to have 5 lakhs with us in cash. That's not stocks, but cash. Another customer required to have is supposed to have 10 lakhs. Then together, the two of them in the bank account should at least show 15 lakhs. Sometimes it can show 14. So you got to figure out why that reconciliation.
So we have to do a daily reconciliation.
So we do a daily recon. We've done a daily recon from 2017. In 2020, SEBI said every PMS has to do a daily recon. So we're like, oh, fantastic, we've done this. And, so it was easy for us to do it because we did it because we thought it was the right way. But now it's enshrined in a rule in SEBI, and everybody else has to do it, which is a good thing. But it affected us a lot lesser than, because we could do it because we had the code, we had written the code to do it right from the start. Now with API banking, we'll almost automate the whole thing so that we are aware of the differences between the two. Now, another part of this operation is what happens when you want to exit. So that's something that people say, well, I want to close my PMS. Or can I partially withdraw from the PMS? So the answer
By
is...
the way, if you partially withdraw, your net balance should still be above 50 lakhs.
Right now, if you started off as a customer who's at the 25 lakh limit, then your balance should be about 25 lakhs. So either ways, the idea is this, that you can withdraw up till the point at which the minimum was when you started the account with SEBI, with us through SEBI. Now, SEBI also has a new rule that says if you started off at 25 and we increase the limit to 50 and your 25 has now become 30, can that person add another 5 lakhs? The answer is no. SEBI says you want to continue that account with that 30 lakhs, please go ahead. But you want to please add at least 20 lakhs to make it 50 and then participate, because this addition of only 5 lakhs is not possible. So we said, okay, that's fine. So a lot of our customers then added the remaining, or they just said, let's pause. So they can't do SIPs until they reach the point at which, luckily, one of our customers, in fact, right today, the account has literally reached 50 just on its own. So now that person qualifies to be able to add SIPs. And this is an exciting time for us because we can tell people that, listen, now you can get closer to your longer term goals because you can do the monthly additions that you need
Missed
to do
out
in
on
order
the last
to
1-2 years.
1.5 years. So now what's also interesting is because we don't have distributors, we can directly communicate with our customers all of these concepts without them getting lost in the ether, right? So it was useful for us to build that relationship so that we could directly communicate. Now, the second part of this is the distributor part of this framework is that the distributors typically get all these forms filled. They come in, they do this. The fees start getting charged from the day your account opens.
Is our entry loads still allowed?
Entry loads are allowed, exit loads are allowed, lock-ins are not allowed in a PMS.
We have nothing.
We have none of them. We basically made it so simple that I almost...
In fact, it costs us money to, like, we do all the form filling, printing out, because it has to be, printed on a stamp paper. It can't be done online. You have to get it done and then courier charges, so on. So whether you become a customer or not, eventually it still costs us $500 to $1,000.
Yeah, and we are perfectly fine with that because that's the cost of acquisition of a customer. And if I told people that was the cost of my acquisition of a customer, this would be still the lowest cost of acquisition of a customer because
imagine somebody charging 2% but paying 1% to a distributor.
Correct, because I mean, in the end, you're and that's a noose around your neck for the rest of your life, because you may continue to service the customer forever, but and it may not necessarily be a noose because distributors sometimes do add value. But the point over here is that, okay, so we realized that we had to print all these forms and write it. At some point, I think the point was, listen, why are we used to fill these forms with ink. Now, because you fill them up with ink, sometimes there'll be a scratch. And when there's a scratch, the custodian will come back to you and say, guys, there's a scratch. The customer has to cross-sign across the scratch. So the custodians would tell us, please take cross signs everywhere. Wherever you're filling in numbers or something like that, please take a cross sign even if there's no scratch. Because tomorrow, if they suddenly find a scratch, then it's there. So we're like, what is this nonsense? So we figured out the problem really was that somebody was actually entering or writing in stuff in their handwriting. So we built a tool that said, let's take the data electronically, let's fill the PDF in place, generate the form so that the only thing people need to do is sign at the bottom of the page.
This is also now a SEBI requirement. You have to allow customers to self-onboard.
Yes. So now customers, the SEBI said, don't only have distributors, let people come to you directly and remove the distributorship fee and give them a lower cost. Plus, let them self-onboard. So now the PMSs are saying, listen, I'm not going to fill forms for my customers. We said, we also don't want to. So we made it such that all of this data, if entered electronically, could be automatically filled in. And despite everything, we would still have problems because customers would forget to sign something. So we said, you don't print anything. We will print it here. We will put little yellow tick, little stickers on where exactly you need to sign, so that when you get the forms, you just have to look for the yellow stickers and sign there and send them back to us. The unfortunate problem of form filling, but we have done that. So tomorrow we will also, because now SEBI very recently has started to allow digital onboarding. Till now it was not allowed. So we're going to be doing digital onboarding as well. So because the only form that legally is not allowed to be done digitally is a power of attorney. So we'll have to get that only one form signed.
So instead of giving us like 20, 30 signatures,
yes,
it's just one or
it'll
two.
Be one signature and, it'll make a lot of people very happy. So that, I think, is, so in general, if you go to any PMS, all this process will still be there. Luckily, it's not there in mutual funds, and hopefully it'll not be required in PMS also, but that's the process. Now, exiting, entry, and the time frames. So typically your time frames are 5 to 7 days to get accounts started, because that's the time it takes to fill forms and so on. Even exits take that much. I'll tell you why. Because if you're selling stocks, the earliest you'll get money is 3 days later. Then you have to tell the custodian, please transfer the money back to us so that we can transfer it to the customer. The custodian will take another day to do that. And then we can take another day sometimes. So in the meanwhile, we do things like verifying bank accounts and make sure everything's in place and so on. Sometimes some stocks don't sell easy because they may not be enough liquidity. So that can take a few more days to sell. That's another thing that we
Particularly
take
if it's
care
a
of.
large account and you own quite a bit.
Plus, what happens is maybe I have been buying for you. So, if you tell me you want to exit today, and I have some stocks that I have bought for you today itself already, I have to wait for those stocks to come in before I can sell them because I can't
So it
sell
takes even
stocks.
longer for
Yeah, it
those
takes
stocks to be
even
sold.
long. So sometimes those processes can take
It takes
5 to
10
7
days.
days, 5 days. So we try to keep our customers informed through the process, but that's the kind of time frame you should expect if you go to a PMS, that it's not available instantly. Some of
Acha, who are all the players involved? In the list of documents, you see all those things. So, custodian कौन है? ICICI Bank, not ICICI Securities.
Yes. So this is interesting because ICICI Bank is the custodian, not ICICI Securities.
And we
And-
will create a new demat account. Even if you have and this is the most common question we get.
Yes.
I already have an account with ICICI Securities. Can you just use that demat account?
Yeah, but basically what they're telling you is we are giving you an account with a lock and key around it. Tala hai, you can't touch it. We can't touch it. Only the custodian can touch it. So in that case, they're saying, yeah, if you give me your existing demat account, then you will do something to it. You will go buy some stock, and we won't be able to reconcile our systems. So you're not allowed to touch it. So they create a separate demat account. Second thing that happens here is, okay, let me tell you this: the custodian can go bust. Our custodian did. ILFS Securities went bankrupt.
That was one interesting 2 months.
That was an interesting
period.
2 months because we suddenly realized, okay, they've gone bust, but are they still? Is everything safe? The answer was every single thing. We didn't lose a single paisa in anything during this entire process. What we did was appointed a new custodian, transferred securities over. It took us some time because we had to open all new demat accounts at ICICI.
Yeah, we had to open all new demat accounts in ICICI, and we have to close all the accounts over time at ILNFS, and you have to do a demat to demat transfer. And so on.
So luckily, ILFS, when it didn't go bankrupt overnight, it took some time before it went bankrupt. So we were allowed to slowly transition, and it took us a month to transition it. During that month, we were afraid to trade because how do you trade? Our broker said, listen, who is your custodian? So we couldn't say ILFS because it was not. We couldn't say ICICI because ICICI didn't have all the accounts yet. So for about 30 days, we didn't transact. Luckily, nothing major happened, and plus, anyway, the portfolios were relatively secure. But what was interesting through this process was we learned something very interesting. The Indian financial system is probably one of the safest in the world because the custodian went bust here. The largest custodian in India went bust. Nobody saw an impact, not from the custody operations. People saw an impact from F&O trading and a bunch of other things, which we don't do. But none of the custody operations across the world, across the market got impacted. We didn't either. We moved to ICICI Bank, and ICICI Bank has no. If ICICI Bank were to fail, your securities would still be safe.
ICICI Bank is officially too big to fail.
Yeah, I mean, so technically, if it failed, then your problem would be other things, but not your securities. Beyond that, your securities are held at NSDL or CDSL, not at ICICI Bank. So they are just a depository participant. So they use a depository participant license and the custodian license to work with. So you have a depository participant, you have a custodian, then you have a broker.
So the depository is the NSDL and CDSL are like the giant ledger of who owns what.
Exactly.
And these guys are like the DP participants are the accountants who make the entries.
So there, in a way, if you think of it, it's like I have 100 ledgers. As a depository, I have 100 different ledgers. Each ledger says, according to ICICI Bank, in the account of ICICI Bank, we have person X, Vashistha Iyer, owning 100 shares of Reliance. In the account of Sher Khan, same Vashistha Iyer owns 40 shares of Reliance. So they have different ledgers for different. So think of each ledger as a depository participant who says he has accounts and each of those accounts are different. So the demat account is with a depository participant. The same user, you and me, can have different demat accounts, demat accounts with different providers. So as a single PAN, I can have an account with ICICI, an account with ICICI Securities, different company, an account with Zerodha, an account with Sher Khan, and
And they're all separate demat
they're all
accounts.
separate demat accounts. From tax purposes, they're different. The FIFO applies on a per demat account basis, so you can sell from one demat account, and only the buys from that demat account get matched to the sells from that demat account for the purpose of taxation, even though you may have an older holding somewhere else. So the first in, first out principle applies on a per demat account principle. So PMSs therefore are individually taxed separately. What's also interesting about PMSs is that since the accounts are separate, the depository participant is separate, the depository is separate, and so on, you actually can go to the depository itself, NSDL or CDSL, and get an account statement. You will see all the holdings in that account statement, which is also why it's a stupid idea for us to hide from you what you actually own, because you can go to NSDL and
The
say,
only nuance here is that it will take 2 days to reflect in that.
yes.
Versus if on our portal, if you log in, you will see immediately on the next day.
Yes, because with the day I buy something on your behalf, I'll reflect that on the next day. Whereas NSDL will wait until the
Trade is
shares are
settled,
actually settled, which is 2 days later, T+2, to show. So you may have a slight discrepancy. But the point is the system is actually safe this way. But now how do you trade? I can't just go buy stocks. We're not a broker. So we use the services of a broker like a Zerodha or a...
In our case, it's Zerodha.
In our case, it's Zerodha. We tell Zerodha, listen, we have one trading account. That's trading account for the purpose of the PMS. We will go there and punch in orders. We will never give any money to Zerodha. Zerodha says this trade is going to be settled by the custodian. So ICICI Bank says, okay, how much have you bought exactly? 500 shares? That's fine. Just we'll pay for 500 shares. But we will pay the exchange directly. No money goes to Zerodha. So we're one level safer. If whatever broker we're using, if that broker goes bust, of course, Zerodha is also possibly too big to fail. But assuming that a broker goes bust, you don't have any exposure because you're not keeping any money with the broker. The custodian themselves are paying the exchange and receiving shares from the exchange, or giving shares to the exchange and receiving money from the sales. How does Zerodha get paid? They make a bill to the custodian saying, listen, this is our brokerage charges.
These guys bought this much share, I need money for this.
Yes, and the custodian tells us, listen, they've asked us for this much, I'm going to pay them. Are you guys okay with it? And you say yes, and then it's done. And all this is electronic. So, there's a series. Of course, when I say electronic, sometimes half of it is by email. We will come to that because this whole industry needs a big lesson in how to use APIs and electronic transactions rather than email transfer of CSV files. But let's leave that on a different note. Having said this, all of this process is a concept of saying how complicated the system is, because you're buying through a broker, it's getting settled by a custodian with a common bank account through an exchange. The exchange has 3 layers. The exchange, now we don't just deal with stocks, we deal with mutual funds as well. So on the exchange, you have a clearing corporation and the exchange. All custodians are very good at this. But the mutual fund system has a different game altogether. So we use something called MFU. The broker has to punch the order in MFU. We used to use BSE Star MF earlier, but that ended up having some certain set of issues. So we go to MFU now.
But we go through the custodian.
You go through the custodian punches the order in MFU, the MFU receives the money or the securities, and then confirms the order through an RTA, a registrar and transfer agent like CAMS or KFintech. The CAMS or KFintech aren't the mutual funds we're buying. So we're buying the mutual fund, like an IDFC mutual fund, through a RTA, which is called CAMS, which is order of which is being punched on MF Utilities, which is a different company, which the order is actually punched by a custodian. So
who got the instruction from us?
You got the instruction from us. So 5 different entities in one transaction, and the transaction can fail at any one of them. So we have these different points of failure. So over time we figured out...
Which is also why our systems update the next morning, because you have to wait for all these things to settle.
Yes, and they all, anything can go wrong at any time. Sometimes they'll say, oh, well, we didn't receive the money in time, so you're not going to get today's NAV, you'll get tomorrow's NAV. We say, no, we're not okay with that. They'll say, okay, then we'll send the money back to you. So they take to 1 day to send the money back, and the whole. So sometimes part of this is manual simply because nobody knows why this transaction didn't go through. We call the custodian and say, what happened? Where are the units? They'll say, wait, we'll tell you. They call up MFU, and MFU says, wait, we'll tell you. They call up the RTA, who says, wait, we'll tell you. And by the time, all of this. So this wait, we'll tell you is what causes like 90% of my gray hair in the beginning of this thing, and a lot of gray hair in the company as well, because everybody has to go through this. Oh my God, where is the money? Have we lost? How long is it going to take us to find the money back? That was the biggest problem.
Yeah, it's not that the money gets lost. I mean, it'll come. The problem is we can't update our systems, because if you've bought for 100 people, we don't know the NAV we are going to get.
Yeah, or whether we're going to get it or whether we're not. So how do I know whether I have cash to buy tomorrow if the transaction did go through or didn't go through today? So everything became this, night. But now I think everybody's got it licked and said, okay, well, things happen. This is how it's going to happen. And all PMSs go through
Learning
this.
curve. I mean, everybody goes through this.
So eventually, a lot of PMSs do things like, for instance, you can ask us, Deepak, you guys sometimes have cash sitting in the account, and if it's 2% of 450 crores, 9 crores sitting in the account, you're earning no money out of it. Why can't you put it in an overnight fund and earn some money for the customers? If I have to deal with a custodian, RTA, mutual fund, MFU combination where something fails, and in the next day morning I don't have cash to buy shares for whatever reason, that is a bigger nightmare for us than to earn that microscopic bit of interest that we will get for that overnight for this thing. So we're like, okay, listen, this is cost of doing business. Less complications, more reality. When we get this system down to a T, we'll do that also. We'll optimize and get you a little more return at that point. Because yes, I charge you a 1% fee. If I put that 2 or 3% of cash that we maintain sometimes, we might be able to offset maybe half.
But it's the same with mutual fund. Mutual funds also have 2 to 5% cash all the time, because they have to worry about redemptions and cash flow management and so on.
Here's the good thing about mutual funds is, since they own the cash and they don't have to deal with these 7 different layers, they could buy, for instance, they could go and buy overnight TREPs, or something like that, which allow them to transfer, where the money coming back tomorrow morning is guaranteed, and they're only dealing with, say, an RBI.
That return is not meaningful in any way.
In any ways, yeah. So, and today it's not. Maybe one day when it is, the difference will be formed because of that thing. But main important thing is this: PMSs can't earn money off of that float. If I earn even a single rupee by putting money into an overnight fund, all the cash balance that I have, I know it's going to earn some interest. That that interest that has to be earned by putting the money overnight anywhere has to be done in a format that transfers all that interest to every single customer that we have.
In proportion of their cash balances.
So that means you may see, if we do this, you will see like a 20 rupees, a 30 rupees, that kind of number come to your account every day, and you'll have to pay tax on that income. But essentially, that is that will be an extra addition to your ledger every day. Not many people do this. For instance, a broker could do the same thing and give you interest on it, but they don't. A broker could allow you to buy a mutual fund every day and buy it back. They don't. And that's because of this complication. Something goes wrong. How are you going to track all this stuff, right?
But the cash is supposed to be cash.
Yeah, and
you need the cash because there's some transaction going to happen.
Yes, and tomorrow
and cash can be there in an account for multiple reasons, right? You could have rebalanced and sold something, so you are waiting for cash to come in. It could be a dividend that's receivable, so it shows up as cash because it's going to come at some point. And then you have some cash reserve because you want to account for fees and transaction costs and so on.
Yes, because we don't ask customers for fees. The PMS will say, listen, I'll take the fees out of the money you give me. But if I invest 100% of it, how do I get the fees out? And the fees are important because that's what keeps the PMS running in the first place. So you say, okay, if we're charging you 1% a year, then 0.25% I can keep as a fee because I charge you on a quarterly basis. I don't invest 0.25%, I invest the rest. Then off the rest, some of those stocks will pay dividends. When they pay dividends, another 0.25% will come in. So I pay the first 0.25, another 0.25 has come in. That will work for the next quarter and so on. So the typically fees are paid through this process. Taxes, and because dividends are taxed now, all mutual funds will have to reveal at least what tax they have to what tax they have to pay. And we even go a level further. We talk about how every individual has different taxation requirements, but those taxation requirements can be viewed in two formats. First, when do I have to pay my advance tax? So we actually show you your taxes based on 15th of June, 15th of September, 15th of December, because these are tax payment dates, and what are the gains you've incurred in those dates rather than all at once, so that you can find out the appropriate kind of advance tax you have to pay on a real time basis. So every day when you go, you can see what taxes you may have to pay based on income and dividends that you've received. The income is primarily from stock
Dividends
selling and capital gains, for us at least, and dividends and
for the
interest is
user.
yeah. So the user has to pay this. We don't pay the tax, because there is a good reason why we don't. Because you may have multiple PMSs. We may have made a profit. The other PMS may have made a loss. You can actually offset the two and not pay any tax. So we don't pay any tax on anyone's behalf. We expect the customer to pay it. Typically, if you're a salaried person, such a number may not be significant, and therefore you may not have to pay any extra taxes, because your salary itself, the TDS that is being cut, qualifies for your tax payments. However, some people who have business income or who have no other form of income, they are retired or so on, they may have to pay some of the taxes. Remember also that advance taxes are not payable by people who are senior citizens. They can who decide not to pay unless they have, if they have business income, they have to pay. But if they have non-business income, they don't have to pay any advance taxes. So they can wait till the next year tax filing in order to pay. Importantly, taxation is different for different types of trades. So a short-term trade in equity is taxed differently from a short-term trade in debt, from a long-term trade in debt, and a long-term trade in equity. So we have a taxation module that helps you that segregates all of this and shows it to you on a regular basis. Any good PMS will have this. I mean, this is table stakes. Everybody will want it, but we've just integrated into our portal so that you can get this kind of data on a regular basis whenever you want it, and if there's any tax impact of what we have. So we also segregate, for instance, the Nasdaq 100. It's a stock that's traded on the exchange.
But
It's an
tax
ETF,
like debt.
but it's a tax like a debt fund. So we've segregated that part separately. 2 years ago, the dividends that you received were not taxed. One now dividends you receive are taxed. So there's a difference between those two. So we've built a lot of that technology to ensure that the taxation is right. Lastly, now, and unfortunately, this is a very complex mechanism. If you receive dividends of more than 5,000 rupees in any financial year from one company as dividend, then a TDS of 10% is deducted. This 10% was 7.5% last year. It's 10% this year. So we keep a track of that as well, saying, okay, you should have had so much in dividend income, of which so much has already been deducted. So we kind of keep a track of that as well. And this, the tech team is probably hates the whole world for this at this point, but this has happened, and we've kind of done this in a way that goes on. The last part about this is this: every PMS is required to provide an audited statement of accounts to its customers. Now, typically, and a PMS will charge you 1,000, 2,000 rupees for such an audit statement. We don't. Why don't we? Because what we've done is we've said, okay, what does the auditor really need in order to audit your accounts? This is a certain piece of information, transaction statements, X and Y, and so on. If we can make their life easy by getting exactly what they need in the format, a balance sheet for each customer, a profit and loss statement for each customer, a cash flow statement for each customer, balances of each account mentioned in a way entirely through technology. So we actually generate these statements out of our databases and give it to the auditor, and the auditor looks and says, listen, you've solved my work so much that I don't need to charge you that much larger fee that I would otherwise have charged you. I can charge you a lot lesser. So we absorb some of that cost and not charge people, even though we can, because this is incidental costs. We say, well, we've made it so that it's a lot cheaper for you, and we've absorbed that cost. So even if we were to charge you that cost, it would be the order of hundreds, not thousands. And that is so much that is so much in our ethos that we want to keep that. We don't need to. We could have just said, and every PMS does this in the sense they might just say the cost of audit is yours. We've tried to do it in such a way that the cost of audit is also taken. But every little 100,000, 2,000 rupees adds up. I mean,
Yeah,
if
I mean,
you
imagine somebody who's invested a crore in just our passive portfolio at 25 basis points.
that's 25,000 a year, 2,000 rupees a month. If I charge you another 2,000, I'm charging you a 13th month effectively, which is not fair. I mean, but also I think this it's the concept that says, listen, we've made the system more efficient. Otherwise, one auditor would have to put three people behind this for 500 customers and spread this audit concept over 3 months. We literally, once we generate all the statements and get all the balances confirmed from our custodians and everybody else.
So now it takes us 1 or 2 months.
Yeah, it still takes us a little bit of time because we have to confirm balances. What happens is, it's not just because first our audit has to happen and then customer audits happen. So because when we have our audit
We sent
done,
out our latest ones in June.
we sent it in June this year. We hopefully next year we'll try to send them in April as well, so that we can have an internal company audit by April and send the whole audit statements for all our customers. These are audit statements, they're not tax statements. There's a difference. There are two kinds of entities in India, two kinds of taxation, two kinds of profits in India. One is the profits according to the Companies Act and therefore according to accounting standards. This is different from how the income tax expects your taxes to be filed. So we have a taxation module that shows you how income tax will expect your returns to be filed, which is your transactions and the capital gains and the short term, long term, this, that, dividends, and all that stuff. That is a different format from how your audited statement looks, which is the profit and loss or balance sheet and so on. To explain the difference, I'll probably have to go and do a course in accounting, which I'm doing right now, and I'm
As
finding
part
out
of your
as
MBA.
part of my
Again,
MBA.
a new rule from SBI.
And another
SAB,
from
sorry,
SEBI, not
SBI.
SBI. Nowadays, to deal with SBI, also need an MBA, but with SEBI also. But the interesting thing about the difference between these two is that the taxation department may decide that certain things are not expenses. Like, for instance, they'll tell you your PMS fees are not expenses. But the accounting law says you can account for the expenses as expenses in your books. So the taxation department will deny you a certain expense, where the accounting laws allow you certain expenses. So you have two different books. One is what you can show the tax department, what you can keep as your personal set of books, which are allowable. So because of this, this is very peculiar to India, I guess, but this is how it is, and that's how the system actually works internally.
Okay, so we've learned how PMSs work, the operations bit of it. What about, since this is done in the client's name, right? It's in your individual account. Why not just do a small case?
So
what is the advantage of doing a PMS?
That's a brilliant point. And small
we
cases
also
like
publish our momentum portfolio as a small case.
Yes, our momentum portfolio, though it's slightly different from what's in the PMS, and the momentum portfolio itself is different because of reasons I'll explain now. If you do something as a small case, what small case will do is to place a market order for all of those securities at 9:15 a.m. as soon as you press the OK button. This is not the most efficient way to buy anything. As we have seen, sometimes a stock can jump up just because of your buying. If there are 1,000 small case users, they can all buy at the same time at 9:15 and cause the stock to jump up 8-9% sometimes, simply because there's not enough sellers in the market at that particular period of time. So how do you optimize execution? Either you stagger the 9:15 to 9:15, 9:30, 9:45 and so on, which small case can do. But also, if you're buying a relatively small capish stock, you may end up raising it because, normally also there's not so many. And now 10 crore worth of orders are coming in one day, which is simply going to kill the stock's volume because there's not enough sellers. So the stock will go up 10%, 15%. Maybe you have to buy it over 3 or 4 days because of the amount of money you're putting in. Now, if you're putting in 1 or 2 lakhs, that's one thing. But if you're putting in 50, 60 lakhs into a strategy like momentum because you really like it and you have the money to do it, you're going to have to spread your execution and plan your execution over time. You can't do this manually. Now, you have 20 stocks, you got to plan. Acha, iska upper circuit hai, iska ye hai, iska wo hai, and all that stuff is a thought process that you don't want yourself to do. So we are careful in the PMS to include only stocks which have enough liquidity, and then we execute manually over a period of time. rather than all at once. So we may put a little bit of an order today, now, and then a little bit of order tomorrow, and a little bit of order day after tomorrow, and so on. The second part of this process is how does the small case, exit and enter? So a small case, you can sell a stock and buy back a stock, buy another stock on the same day. There's an 80% rule, but regardless
But
of that,
that's a headache.
that is a headache because
Because
what
if you say you have 5 lakhs and you're selling 2 lakhs worth, now you got only little bit of
1.6.
that 1.6. You sold for 2 lakhs. You can buy only for 1.6 lakhs.
Yes.
So baki 40K you have to put from a bank account.
Yes, you have to find another 40,000 rupees to buy,
Huh.
put that, and then
Then
place the buy
tomorrow
order.
that 40K will come. Then
Yes.
you have to take it back
Take it
out
back.
if you want. Other most probably just forget and leave it in your
Yes.
brokerage account.
Brokerage
So you have
account.
a cash drag.
Yes, you have a cash drag. And then you don't even realize what that cash drag is because a small case doesn't know about it. Because
Yeah.
they don't know why you have that cash in the bank
Yeah,
account.
they
They're not
don't
gonna
know
ask
the
you.
cash about in your trading account. You just know the stocks that you've bought as part of the small case.
Correct. And that's perfectly fine. But that dilutes your personal return. So if I invested 5 lakhs, but I actually have to have 5.5 lakhs of cash, what is my return on 5 or 5.5? And at 5.5, 14% will become a 12%. So it's the difference, small of these differences between what you can do with a small case versus what you can do in a PMS. In PMS, what you give us is what you've given us, regardless of whether we've kept it as cash, stored it as momentum, it's a receivable, not receivable. That is not we show you returns on the amount of cash you've given us.
So once you reach a particular size, and we have clients on small case who have like 20, 30, 40, 50 lakhs.
Yeah, and some of them come back to us and tell us that how do you solve this problem? And we say, well, the
Please
problem
give
is
us the money. We will
Yes.
manage it because we have the tools and resources to do it.
to do it. And this is not just for us to earn money. I mean, the point is we're doing work, so we will earn money when we do that. But the point is to ease effort. I mean,
And it's
how-
not that product is not suitable for like very large
it's
deployments.
Not, it's not, and because it's market orders, it's like saying, what is more efficient? At some point, you want to own your own car. At some point, you want to take a public transport because you don't want a hassle of parking and finding something and this and that and all that. Or you hire the services of a driver who will take care of all of this for you. Whichever way you do it, one of the things that is absolutely clear is that a PMS will execute on your behalf, and a small case is passing the
It will make
execution
it easier
framework
for you, but it's still your headache to go and do it.
Yes. Because if a stock is lower circuit, it will not sell it. You'll have to go and sell it manually. If you want to wait till the lower circuit breaks, that could take 10 days.
So every day you have to go and see.
Every day, and you have to go.
So
and
it
place
might
the
be
order.
that it will rebalance only every Monday, but there's one lower circuit every day. I have to go and try.
So think of a PMS as the guy who's keeping on looking at the screen and saying, lower circuit break hua kya? Hua kya? Acha ho gaya, let's go. So that's the thought process that's different in the two. But and any PMS will. We're not going to highlight that only we do it. Every PMS eases execution effort for you, and that's their job. That because they're the ones who are closest to the market. They know when volumes are moving up and down, and when they're able to execute better and not. So I think every PMS will want to do this for you.
Okay. What about, we talked about mutual funds versus PMS. We talked about small case versus PMS. What about hedge fund, AIFs?
Yes, so I
Cat 3
think
AIFs.
that's a very interesting point because Cat 3 AIFs come closest. There's a difference between Cat 3 AIFs and what we do as a PMS is that a Cat 3 AIF is actually a pooled vehicle. You actually send the money into a single pool. The problem is they don't get the taxation efficiency of a mutual fund. In fact, they get the taxation inefficiency of a pooled vehicle like a trust. Because in a trust where you'll get taxed on business income, I mean not capital gains, but business income at 42.7%. So there are some long short funds. Then AIFs can do this. They can go, like I said, PMSs cannot leverage themselves. AIFs can leverage themselves to a factor of 2:1. That means if you give them 100, they can bet on something worth 200. This is good, but this also means that on that leveraged part of the portfolio, which is typically done using futures and options, you pay business income based taxation, which is 42.7%. And this is 42.7% from the first rupee you earn. No 10 lakhs free, 5 lakhs, this much and all. No slabs. So it's 42.7% on this business income earned on the futures and options part of things, which is what gives you the leverage. And the same 10 or 15% on the stocks part of things. AIFs can do things like have lock-ins. They can have entry loads, exit loads, profit share, all of that stuff alongside. They can also do leverage, but they have this major tax disadvantage when they try to do leverage. They also have a very different form of functioning. They will still need a custodian. They will still operate using a but they don't have the same level of transparency like we do in the sense in the PMS. So they can tell you, listen,
Top 10 holdings.
Yes, top 10 holdings, or even the 100
They can
rupees
give the
is
whole
worth
thing also.
101. Yeah, they can give you the whole thing, but in many cases they just don't. So we're trying to deal with an AIF that's investing in real estate that literally refuses to tell you anything about where that money has been invested right now. So we're trying to like literally go down to saying, listen, we need to know something. If you don't tell us anything, how are we going to even have the confidence that you've invested it in the right place? But AIFs can be extremely secretive, which is why the minimum investment there is 1 crore. SEBI's belief is if you're willing to give some fellow 1 crore and on the basis that he may not reveal anything to you, you're either stupid enough to deserve to lose your money or you're rich enough or both. So they're like, if you're rich, we don't care. It's fine, because if you're rich enough to give somebody 1 crore rupees and know that then they have the ability to not tell you where your holdings are, then it's perfectly fine for because now you need to be rich enough to be able to lose that money. But in general, this kind of stuff doesn't happen. In general, AIFs are clean enough to give a nice
But they still
picture.
have that tax disadvantage, and especially long short AIFs. And
Yeah.
I think PMS AIF World, collates this list of performances for all the long short AIFs, and it seems all of them underperform Nifty.
This is something you pointed out, and you said, oh, look at them on a 1 year, 3 year basis also. They seem to be not giving you as much performance as the Nifty.
Yeah, though their drawdowns are lower.
Their
It's
drawdowns
better
are-
risk adjusted returns. But again,
Yeah, I mean,
because
in a
the
time like
taxation
this,
has a huge drag.
Yeah, in a time like this, you don't care about risk-adjusted returns, right? So unless the concept of the AIF was that I want to be only 60% in equity, 40% in debt. That would make it normally I would return less on a
Right.
good time. But if a AIF is supposed to be fully invested, you're going to at some point of the time look at them for returns. But I mean, I think AIFs form a different kind of solve a different kind of need. For instance, an AIF, not a Cat 3, but I'm not sure whether Cat 3 can, but they can invest in unlisted securities. Now, PMS cannot invest. By the way, a PMS can't even buy US stocks, where we might like it, but we use an Indian ETF to buy US stocks. Because we can only buy Indian listed mutual funds or stocks.
Yeah.
We can't buy US. An AIF can. An AIF can say, listen, I'll take your money, I'll go invest in the US and we'll buy. That's the difference between what an AIF can do and cannot. AIF can buy debt directly. Well, PMS can, if it's listed debt, it can't buy unlisted debt. But now, because of SEBI rules, nobody's issuing unlisted debt. Very few people are. So, as some of our friends in the industry will possibly see a negative consequence of. But I think the problem really is that we've created a vehicle called a PMS, which is for people who can give 50 lakhs plus. Then we have created another vehicle called an AIF, which we have to give 1 crore plus. There are different levels of transparency, there are different levels of operation. But I think the difference between the two largely lies in how much so in both cases you have to trust the manager of the business, but the level of transparency mandated for a PMS is slightly higher than the
So one advantage I can see for maybe a long only AIF, do the same thing as a PMS but as an AIF, is they take care, because if they don't have any FNO, there's no high 42% taxation. It's only capital gains. But there, the investor doesn't have to worry about advanced taxes and so on.
Yes, and of course they'll still pay 42% tax on the dividends.
Yeah.
But that hopefully you can sort out. So there are differences, and I think they're for different kinds of people. Sometimes we have enough of our customers who have invested both in a PMS, in our PMS, and in other AIFs. And many of these things, AIFs are also fancy, right? So they're in a sense they're made by extremely intelligent people, and they have extremely focused portfolios and like 5 stock portfolios that can last for 10 years. So there is no way you can even evaluate their performance before 10 years. So a lot of this is going to be in the future when we decide and look at it and say, how long will it take for some of these AIFs to give you superlative returns? The same thing with PMSs. By just as a aside, I think one of the things that we've seen is transparency helps. So even as an AIF, if we were to create one, we would like to be more and more transparent about the kind of returns we're getting.
Cool. So it's already 2.5 hours, I think, and we should close it down. So let's end with what do you think? What's the biggest value add we've done for customers?
So I think discipline is the number one conceptual value add we've added to customers, in the sense we said you may be smart, you may be intelligent, so are a lot of people. But the difference between you and other people who may have the smarts but not have the discipline is that you'll end up better than them simply because you've outsourced the discipline to somebody else. Some people have chosen to do it through mutual funds, some people have chosen to do it through us. But in the process of earning that discipline, what we've given them is a clearer idea of how the whole thing operates, the transparency at which it operates, how their returns can be shown as a group uh, in total with us, across different strategies, and moving into debt sometimes, moving out of debt sometimes, and so on. But doing this whole thing in a very low cost and efficient way, while at the same time retaining a sense of community among, we promote camaraderie among our customers. So that's some part of it is something that they learn. I think the value adds over here have a lot of little things. One of our customers actually told us today, here's my returns till now, but I think I've made more than this from just associating with you, because there's so much more I've learned through this process. That's partly because they're also a member of Capitalmind Premium, but also because the PMS process itself has gone through ups and downs, and they've seen how momentum, for instance, went into cash during the big fall, but index did not. The passive index was like, listen, we're passive, we're not going to do anything. We just increased the amount of Nasdaq 100, which is a small call that we took. But other than that, there was nothing that changed for that. So that saw a 35% decline, whereas the momentum portfolio saw a 10% decline. So they saw us through that operation. The second thing I think is the fact that a low cost PMS can exist without a profit share and continue to grow. If anybody
And without distributors.
without distributors, I think that, and without the distributors is quite interesting, because many of our customers are used to distributors.
Yeah, and we never thought we'll have like close to 500 crores assets.
I remember when we started
in
this,
4
we
years.
said this, we put this in the business plan saying first year we'll do 100 crores, and in 4 years we'll be at 500 crores. Today we're 482, like till today morning, and today the portfolios have gone up, so it'll be higher tomorrow. But uh, if you had told me in 2017 that in July 2021 we'll be at 482 crores, I would have laughed you out the door, because I would have said, there's no way, this is insane, without distributors, doing this all off it, using technology on our own from a little office in HSR layout, which has become a big office in HSR layout. I must say, we have 4 floors in this building,
Not
which we
enough
are,
employees.
and we right now have 4 people in the entire building. So the apart from that, I think I would have said this is impossible to do, but it's, and I must thank all of our customers for this. They trusted us, they believed in us. Some of them looked at us and said, we've got substandard returns in the first few years, but we'll forgive you for it. And I thank them all for it. But we've come a long way, and I hope they've gained through this process, because we've been able to use momentum and the passive strategies to turn their portfolios around, some of whom have a 50% plus annualized return. Mouth-watering, and sometimes, yeah, to be fair, that's not me, and I haven't got those returns, and I keep looking and say, what have I done wrong in my, because it's about how much money I've added.
Yeah, it depends
each
when
time.
you entered and
Yes.
the timing and so on.
Now, I just basically use a systematic. I mean, PMS. The new mutual fund rules are that mutual fund employees have to put 20% of their money into their funds. I put 50% of my income into our fund. So whatever I save, I literally throw into our funds because I'm happier to invest in our funds where I don't have to make any decisions for my own portfolio, and I'm looking at things as a whole rather than anything else. I think that value add is possibly the biggest we've added. That I think it's just that discipline, low cost, and
I think the confidence that I can give a bigger share of my net worth to this PMS.
yeah, I think
Otherwise, you'll say, "Yeah, I have 2 crores. I'll give 50 lakhs to this. Chalo dekhte hain kitna risk leta hai." Here, we have so many clients who have like 2-3 crore net worth, and they have a lot of it.
Yes,
like
and they're
80% plus
happy
with
to
us.
see that some of their portfolios in debt because they want it that way. And some of their portfolios in equity, which is retargeted at the right moments of time. Hopefully, and we've seen COVID have a very, very rough impact on the economy, and a lot of our customers are told us also, can we do something to help the economy? So we might introduce more kinds of portfolios which allow people to do things like charity, and through, of course, we are just the investing vehicle. They're the ones who are going to do the charity, but we will evolve as the world evolves, and as new requirements come in, new products come in. Tomorrow they're talking about accredited investors who can do investments of less than 50 lakhs, who can do investments in private companies in US markets without having to, the PMS rules get diluted for people called accredited. You can bet that we will do the right things for our customers because we would love to. Our process is do as much as we can for the customer. It's been a very big advertising kind of podcast area. So,
It's okay, man. For 4 years, we didn't do any advertising.
yeah, this is the first real advertising kind of podcast that we're doing. Yeah, fine. Good. So I think we also have a Capitalmind Premium
Coupon, yes. You can, if you have made it so far, you can use the coupon CM Podcast and get a discount for Capitalmind Premium.
Yes, capitalmind.in. You can see the premium link on the right, and please let us know that you have reached this far because we're counting. We know how many hits the podcast has gotten. The more you can tell us, we're at capitalmind_in. Vashisht is at upticker on Twitter, and I am at Deepak Shenoy on Twitter. So please let us know. Capitalmind.in is where all the action is.
Since this is a PMS podcast, so capitalmindwealth.com.
Yes, capitalmindwealth.com. Hopefully, as the new website evolves, we'll not have to give you 2 different URLs. But capitalmindwealth.com, we have our portfolio disclosure document. None of this podcast was for investment advice. Don't think of any of the stocks discussed in this podcast as things you should buy. And if you really feel the desire to buy stocks and do things yourself, there's Capitalmind Premium. If you feel the desire to say, I want these guys to manage our money, talk to us at least first before you take any decision. And we're at capitalmindwealth.com, always available at your service. Thanks for listening. This is a phenomenal podcast, longer than I thought it would be, but more fun to do than I thought it would be for something that explains the concept of a PMS.
All right. Thank you so much, guys. Bye.